Thanks a lot.
Start off with the Pledge of Allegiance. Oh, Julie, you sure see this?
I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
Public comment? No public comment? So, the first topic on our agenda today is discussion and possible action regarding election of Board of Retirement Officers for 2019-20.
Madam Chairman, I would like to nominate a slate of Catherine Cavanis as chair and Dan Jurdy, who is not here, as vice chair.
Is there a second? Is that a motion?
If we need a motion,
What was the slate again?
slate is Catherine as chair and Dan as vice chair.
And is there secretary?
And secretary, I guess I'm supposed to say that too, right? Thanks, Tim. All right,
Tim is
there's
secretary.
Tim is secretary.
Okay.
My second.
I'll third.
Okay, is there any discussion on the motion? Those in favor?
Aye.
Opposed? Abstained? Motion passes. Thank you. That was sweet. I'll try harder, you guys.
You're doing
Nice
very
campaign.
well. Very well.
Clean
I
campaign.
didn't even connect.
I think somebody does it here. Appointments to the audit committee there?
Okay. Next issue for number one is appointment to the audit committee.
Congratulations, Mr. Vice Chair.
Lights are flashing in your car, Jerry.
I know, it's been singing.
So.
Oh, you were gone.
Hi, good morning. Our next, we've done part of the first item on the agenda, and the second item is appointment to the audit committee. That's the second part of the first item. So, do we have any?
I think you appoint these, I think?
Yes.
The
chair makes
I
appointments.
didn't know I appointed.
Yes.
And
The
we
chair
have-
makes these
Are the four
appointments.
existing still here, or?
So we had,
So the four members of the committee, Tim is the chair. Madam Chair, you also serve Lee Parker and Julie Forrester
okay,
are
so,
the four.
okay, so aside from Lee, is everyone else okay with the other members? And would anyone be interested in also being on the audit committee?
That's what I'm saying, do you want to do it?
Are you interested?
I'm always interested. I don't know exactly what it entails, but
It's,
lots of numbers.
All that matters is you're unwilling to say no.
okay,
How often are the meetings?
not very often. It's, what, once a quarter maybe?
Once a year.
But we've met more than that.
We have, but that's when it was audit and budget committee. Now it is just the audit committee. So it should be once a year.
Okay,
Does that work?
yes.
Okay, is there a motion?
There's no motion required.
Oh,
It's
I
the
don't-
chair's prerogative to
I
make those
feel
appointments.
funny just saying, okay, but okay, so it's going to stay the same with the addition of Quincy, thank you,
And the removal of Lee.
of Lee. Sorry. Okay.
Boo.
Okay, so the next item on the agenda is the board meeting calendar for next year. So I don't know if everybody's had a chance to take a look at it. Yeah.
I was just wondering about November, why are we not doing the 18th?
Actuary.
I make a motion to adopt the calendar.
Okay.
Second.
Any discussion? Those in favor?
Aye.
Opposed? Abstain? Motion passes. Okay, the next, we have the consent agenda. Does anyone have any discussion on the minutes, the retirement report, or the preliminary financial report? chance to take a look at it. Okay, so we don't really need a motion.
No, if there are no objections, the consent agenda can be adopted by unanimous consent.
Okay? So the consent agenda is adopted by unanimous consent. And next, the audit committee report, discussion and possible action regarding adoption of financial statements and independent audit report for year ending June 30th, 2019. So I will hand it over to our chair.
We met on the date, November 25th.
November 25th.
Okay, yeah, there we go.
We had a presentation by the auditors via the internet, and you phoned in here and were viewing it, I assume, online with the rest of us. And we went over their report. Since there were no real issues, it was more of just a presentation that we found no issues. We did have a little bit of discussion about one of the findings on internal control had to do with the
Dual control journal entries?
yeah, there were a couple issues on getting into the the pension program and doing journal entries and that kind of thing, very minor, and we accepted their report as presented to us. They will, I believe, come back and make a full presentation to the board.
This is the presentation to the board. We have them available if we want to speak with the audit manager. Based on years past, there's been no real discussion. The audit has been finalized after the audit committee's review, so this is just a receive and file at this point.
Okay.
We have the audit manager available if there's any questions the trustees have. We can have them call in.
Anybody have any questions, or? It was a clear, clean report with no adverse findings, and so it should be accepted.
Do we need a motion for that?
I think, yes.
Okay, is there a motion?
And actually, I believe it comes from the audit
I'm
committee
sorry.
as a motion,
Okay.
since the
I'll
audit
let
committee already approved it.
Tim.
So it exists as a motion already, I believe. So,
Okay, so there is a motion, the audit committee has approved the audit report, is there a second?
don't
Second.
believe.
You-
Okay.
Okay, all those in favor of accepting the audit report?
Aye.
Opposed, abstained, motion passes. We accept the audit report of ending June 30th, 2019. Okay. Are we expecting,
Yes, we're expecting presentations on agenda item number 6. So let me see. Greg. You guys ready? Yeah. All right. Dropping in
Sorry, everybody, no Christmas party. Last year I said we should have one at my house, but I didn't count on getting you.
I think you got a good excuse.
My Christmas tree is just sitting there with nothing on it, so it wouldn't be too festive.
Hello.
Hi.
How are you?
Hi.
Good morning. Maybe we'll just bring the chair next to Jerry. Is that all right?
Yes. Hi, dear, how are you?
Welcome, Greg.
Well, thank you. Good to see you all. How are you?
Merry Christmas.
Merry Christmas. Happy Thanksgiving, all of that. Okay, so you might have our summary presentation in front of you. And we're just gonna tee up a couple searches, evaluations you're gonna make today. And to provide refresh your memory about the background, about what we're doing today. We've been on a long journey in looking at what other asset categories we could consider for the association. And from a big picture perspective, our investment program is heavily reliant on public markets securities right now. US stocks and US bonds, international stocks, not so much international bonds, and then a little bit of private real estate. And there are implications to that, the way we're invested right now. The number one implication is that it works well over the very long run, but it's a bumpy ride along the way. And sometimes we look a lot different from other investment programs, and sometimes we do really well, but when there's a big drawdown in the stock market, we don't look so good and we don't perform as well. So we've been looking at other diversifying asset classes to consider for the investment program. So with this little summary presentation, if you flip ahead to what's labeled page 3 in the bottom right-hand corner of the document, we level set of all the work we've done in this area to date. So we started off in August of 18, where we did an educational session looking at all sorts of private real assets. And we liked the idea of looking at private real assets because one could look at your portfolio in one way I described it before is stocks, bonds, real estate. Another way one could think of this is what does really well in growth markets, what does really well in non-growth or declining markets, flight to safety, and then what does well in inflationary environments. We haven't had an inflationary environment, well, since Paul Volcker, who recently passed, was the chairman of the Federal Reserve. But it doesn't mean that we won't have an inflationary environment at some point in our investment horizon, which for you is virtually a perpetual time horizon. So should we consider other real assets? So we did a study, and real assets are assets that are supposed to perform better than others in an inflationary environment. So we did work on that in August of 2018, looking at all of these things, timber, infrastructure, agriculture, etc. And at that study, that's when we started focusing in on this concept of infrastructure investing. In April of 2019, leading up to an asset liability study, we also looked at other asset classes we can consider to diversify our investment program. We looked at non-US bonds, credit, hedge funds, multi-asset class strategies, private equity, commodities, global equity, etc. And really, and then in June 2019, this year, you met Jan for the first time. And Jan is a member of our real asset group and really has a focus and expertise on infrastructure. And she must have given a really good presentation because that's when we really started focusing in on infrastructure. Okay, if we add one thing, it's not going to be private equity. We think infrastructure is the thing to add. So we did the asset liability study in 2019. And we asked 2 questions at that study. What other asset classes and what's our overall risk return objective? We said our risk return objective is appropriate, but let's consider diversifying. And then we started a search to look for an infrastructure manager. Callan did our due diligence and we came back and made the recommendation of 2 core open-ended infrastructure funds, JP Morgan and IFM. And we're going to have those 2 firms come in today to share with you, 1, why infrastructure is a good idea, and then 2, why are they good at infrastructure. So starting at 9:15, they're going to come in first JP Morgan, then IFM, to share with you those two things. Why is infrastructure good, and why are they good at it? Okay. So we have a couple charts on pages 4 and 5. Should look familiar to you. And this is the backdrop about why we think additional asset classes for the association makes sense. The first chart on page 4 shows how we are invested, and then it shows how other public funds are invested. And you'll see the yellow square here shows all the asset categories in which you invest: equity, fixed income, real estate, international equity. And if you look at the equity ones, the green dots, the association, and you see the green dots are high for domestic equity and international equity. Equity generally wins in the long run, but again, it can be a really bumpy ride getting there. We have a relatively low allocation to fixed income and a pretty good allocation to domestic real estate. But if you look over to the right, there are all these other categories, all these other investable asset categories where we don't have investments currently. As I mentioned, we went through and talked about a bunch of these and eliminated a bunch of them: international fixed income, other alternatives, whether it be hedge funds or max strategies. We eliminated that. Private equity, we eliminated that. And now we're really focusing on other forms of real assets in the form of infrastructure. On page 5, here I mentioned that bumpy ride. It works in the long run, but it's a bumpy ride. So one way to measure, well, how bumpy of a ride is it, is to look at standard deviation, the volatility of returns over time. And here on page 5, the green dot is the actual performance of the fund. The triangle is the policy target. So over the last 15 years, our green dot has done pretty well. It's high. We've had a high return. We've outperformed our benchmark, and we've outperformed the average fund out there. But we've taken on a lot more risk. You read that left to right. To the right is a higher risk. So over any one individual year, we're going up and down in value a lot more than other plans. And we've got to wonder, okay, going forward, is that level of volatility something we want? And can we even produce a return as high as this going forward over the next 15 years?
Should I ask a question? Last month, when I went to Sacker's, RUK did their presentation where they compare us to all the other 37 acts. And if I drew the line correctly on this graph that they had, we had the most risk of anybody. Will what we're talking about doing today change that?
Yes.
Okay.
Yeah. So we're, if you take assets out of the domestic equity, international equity, and you put it into something else that's less volatile, it should, and ideally negatively correlated, your risk should come down. And that's really what we've been targeting with this. Okay. Now, on page 6 here, Jan is going to spend a few minutes and just refresh your memory about what infrastructure is.
Hi, everybody. So private infrastructure encompasses a lot of things, and managers may have slightly different definitions of what is infrastructure. So as the managers come in today, feel free to ask them, what things do you not consider, or do you consider more infrastructure? But it tends to be things that have stable demand patterns. Utilities, transportation, data is a big thing that people are calling infrastructure these days, because we all have our phones, we're all using way more data than we used to. So that's kind of high level. What are some things that could be considered infrastructure? Benefits that we see for investors in the infrastructure asset class is that you may have a more certain cash flow that you can see coming to you from those assets because there's more stable demand patterns. Another thing that is important to look at for private assets is the valuation is based on appraisals, which are done on a more periodic basis and not a daily basis like the stock market, so your volatility is gonna be reduced because you don't have the daily valuation set up for these type of assets. These particular fund managers who are coming in, both of them have portfolios that are invested in the OECD markets, major developed global markets where they're investing. So you're gonna get some currency volatility potentially with those. Both of these managers offer options to invest through US dollar hedged strategies to minimize currency volatility. So that's something to maybe listen to as they're coming in, or feel free to ask them about that, because that's important as your portfolio is, weathering the different market cycles. Real assets is great, I love it, I spend most of my day doing that, but it's not perfect. There are considerations too for investors in the asset class. These two info managers who are coming in, one of them has a portfolio of 19 investments, the other has 16. The one who has 16 investments, they do have underlying investments. They might have a solar portfolio, but they have 20 different solar farms. So they don't just have one investment, they have 20 farms. So it's interesting to listen to them talk about the type of portfolio they have to understand the diversification that you'll get by investing there. This is a long-term asset class, so these managers are intending to hold these investments for the long term. And there's no exit strategy for them, but you may not want to exit either because you're getting good income and good return over the long term from holding these funds. So that's a consideration for investors in private markets. Another thing that's a consideration, I'm on page 6 of your deck, I'm sorry, is interest rate movements. How will interest rate movements impact the value of these assets? What I would say is private assets aren't that different from other assets in the market, so all asset classes will be impacted with interest rate fluctuations. So it depends how the manager has set up their borrowing and their revenue stream for how they'll be able to weather the storm, I would say. So one thing I'm listening to, and I talk to infrastructure managers, is what kind of revenue do they have for the assets in their fund? Is it contracted revenue where they know with some degree of certainty how much they'll get from those assets every year? Or is the revenue more GDP based? If we have a trade war or something else where the economy slows down, will that impact the return you can expect from those assets? So those are some considerations I have.
Okay. So on page 7, we outlined what we talked about in the asset liability study, where we have the current target and then a new target allocation with infrastructure. And what we were talking about was a 6% allocation to infrastructure. So that would equate to roughly $30 million ballpark of an investment. Now, the way these core open-ended funds work is we will select 1 or 2 providers and say, I would like to give you $15 or $30 million for you to invest. And they will then manage their portfolio, and when they're about to make an investment, they will call capital from you. So it might take a year for them to actually get that money and invest it, because it's not like a public stock portfolio where you can just go out and buy, GE or Apple or whatever. The long-term target would be 6%, and we would make commitments to get to that, but it'll probably take us a year to actually reach this target. And you'll see here where the majority of the funding of it is coming from US equity and global equity to fund up the infrastructure investment.
That's the same question.
Yeah.
Looking at the risk here, I
Yeah.
don't see it going in the right direction.
Yeah. So we spent some time talking about that in the study. We have an unduly high level of standard deviation attached to infrastructure and private equity and other illiquid asset classes. And part of that has to do with the private smoothing of valuations for these investments. Your actual experience should be less than what we model for the volatility of the given asset class. So why do we do that? Well, it's a fine question. What we also want to capture is the true economic volatility of the asset class. But your actual market values will go up and down less than that over time for this 6% allocation. Yeah.
And it's safe to say some of us on this board won't be around to see that when the change happens, right?
Speak for yourself.
As long as I've been around, if you're saying 10 years, before you realize, if you accomplished anything, who's going to be here for 10 years? So we're doing something, we're getting at, we're doing something here that's going to affect future boards, not us.
Well, indeed, but I mean, you and I have both been here 10 years. So you've been around 10 years.
Oh yeah, way more.
Yeah.
I have been.
Yeah. And so the other thing about a core open-ended infrastructure fund is that, let's say 5 years from now, you want out, you can put in your redemption, and it's not like they'll give you the money the next day, but it's not a finite life fund where they'll say, no, your deal is to stay in here for 15 years. If you want out, you can redeem. Now, it might take them 6 months to give you the money back, but you can exit the strategy subject to their cues when you want.
Through the secondary market?
Well, no, not even from the secondary market.
Maybe so I can jump in here. IFM, there is no lockout period where you have to hold your investment in that fund for 3 or 4 years. If you want to get out, you can get out. They're also very selective at who they let in. They put everybody through a process to see, are they a like-minded investor? So I think you guys have been through that process, so I'll say that. JP Morgan, if you commit to their fund, you have a 4-year lockup period, where for 4 years you can't get out unless you pay sort of a convenience fee, we'll call it that goes to the benefit of the fund investors. So that's something to bear in mind with both of them, but it's a decision we hope you take and you stay in the fund for a while. It's not something you dip in and out of.
And I contrast that with a private equity fund or a closed-end infrastructure fund, where you would make a commitment to them today, and that fund will live on for 12 to 15 years, and you can't get out unless you sell it in the secondary market. And these funds are designed a little differently, where if you want to get out, you can't put in the redemption queue, and they will pay you out. Subject to the rules that Jane was talking about.
I have a question, what would prompt an entity to want to get out of this investment? What are some examples of why you would want to let go of that?
Well, if an entity like you, if for some reason your liquidity profile changed, which I think is very unlikely, especially given the level of illiquid assets you have. Let's say something happens at JP Morgan and you picked JP Morgan and you don't want to invest with them anymore. You might want to redeem. So there's a really large open-end real estate fund right now that's going through that. But that's a pretty rare occurrence. Naturally, we wouldn't be talking to you about this if we thought you would down the line be pulling money out. But that's a couple scenarios where you might.
Yeah, I was just curious.
Following up on that, Greg, is there any legal or regulatory risk involved with these, since we're buying? I mean, they're very illiquid and they're buying globally. We'll talk about that. Maybe that's a better question for Jan.
Yeah, I mean, legal and regulatory risk. I think both of these managers when they make investments, they want to be seen as good partners in their community. And ESG, environmental, social governance concerns are something that they bear in mind with their investments. So when they make an investment, they consider all of that to be making good investments. And then through their operation, they want to work together with the regulators who are operating there so they can continue to run their business, serve their customer, and make the profits for their investors. So with any sort of public investments, you do have a high degree of sort of responsibility. Both of these managers take that seriously, I'd say. So feel free to ask them about that as
Okay.
well.
So no real, I mean, in their evaluation of the deal, they're going to be looking at the political environment of the country and all that kind of, okay.
Yes, and I'll be honest with you, nobody saw what was coming with Brexit and the difficulties there. Both of these managers have investments in the UK, and they can talk to you about how those investments have performed, what their expectation is.
But what's unique to, like you have public equity exposed to Brexit, but what's unique about infrastructure is, if you have a toll road, you intersect with the government a little bit closer than if you invest in a company. Now, toll roads isn't a big, huge component that we're talking about, but they're certainly headline grabbing.
Yeah.
It's something that's really tangential. You can kind of get that story. So some of these, or if you work with a regulated utility, you've got to interact with the government, and the regulator has influence on how you pass through pricing. There are some unique legal and regulatory intersections with infrastructure.
To that point is, both these companies look very different in what they are buying or building. Also, their distribution by region, one has like a 15 or 16% in South America, which to me is like a 16% in South America. How would it affect performance in this?
Yeah, so that is IFM, and they have some toll road investments or road investments in Peru and Mexico, and so that's what that investment is. Those are OECD large countries that have global trading. So you're right, it is different. It's not the US or Europe main exposure. So they've done that because they believe that there's growth there, and there's enough investor protections that they'll be able to operate those assets and make a profit. What I'd say for both of these managers is they both have significant investments closing right about now in the US. IFM has a big midstream investment closing that they can talk to you about, and that will shift their portfolio to be a bit more US focused than it is right now, and it'll take it down. It's a lot of transportation exposure in the IFM fund right now, so that will shift to midstream US exposure. JP Morgan is also closing on an electric utility in Texas that will give them more US and more, JP Morgan is closing on that right about year end here, so that will give them more US exposure, more utility exposure in their portfolio, so.
Are you going to go through your side by side before we talk about it?
Happy to do that if you'd like.
So maybe just spend like a few minutes on each and just kind of prep what we're probably going to be hearing.
Yeah, you may hear a review, so I'll go a little bit quick, and I'll be here after as well if you have questions.
I guess the points that would hit you in the side by side probably would be good to hear.
Okay.
Than what this thing down.
Sure. Are you on the IFM investors?
I'm on the
page?
chart.
On the chart.
You produced the side by side chart.
This one here?
Yeah.
Yeah, that's a
Wait a
favorite
minute,
chart.
that, it's, I don't know what page it's on.
Oh, yes, that's the page. It looks a little smaller right
Okay.
here. No, but you have a better reading view there. So this is what we call our side-by-side comparison of the two managers. IFM is on the
29.
Page
JP,
29.
thank you, JP Morgan on the right. IFM is an Australian-based firm. It was founded
Good
by
luck.
pension
That one.
funds. And they have, a goal of investing in long-lived assets to benefit from appreciation of value over time and the income there. The IFM fund, it was founded in 2004. The main fund, the US dollar fund, which invests in the exact same assets and invests parallel to that main fund, was founded in, I believe, 2016. And it's a US dollar denominated fund. But the overall assets have been, the portfolio was started in 2004. The fund's net asset value is pretty sizable, 23 billion. Their queue of capital to be called is about $5.5 billion. So it'll take IFM probably 12 to 18 months to call your capital because they can't predict the pace of deals, so. that's
Deals mean investments that they'll make.
Investments that they do, right. And then other things, they have a similar return target, both of these funds, in terms of what they're promising to deliver to investors. Both funds will pay dividends on a semi-annual or quarterly basis. And you, as the fund, can determine if you want to keep that cash in the fund or if you want to reinvest it and buy more shares, essentially. And that's a decision you can make on an annual basis. In terms of number of assets there, you see IFM has 16, and JP Morgan has 19. And what I would say is IFM has some larger investments, airports, roads, ports. JP Morgan has more portfolio investments where they have a solar company that has 20 different solar farms. So you have different sunshine levels at those farms that kind of change the performance of that asset. You're not relying on just one location. So maybe a bit more diversification within JP Morgan because they have so many different underlying assets there. In terms of fees, we have that on another page that's a little easier to see. I'm not sure if there's anything else I can tell you high level at this
So
point.
you were starting with IFM, and you mentioned that Australian company started by Australian pensions, right?
Yeah.
20-some billion, 5 billion Q.
And I mean, JP Morgan is a large US-based multinational firm. They are in major markets across the world. They have very good presence, which helps them to source deals, have information to evaluate deals. And they can leverage that overall firm knowledge as sort of find deals, operate deals, and manage the fund. So both of these managers are well regarded in the industry. So from that perspective, they rose to the top in our search process here. The JP Morgan fund is a little bit smaller than the IFM fund. It was started later as part of it, and just these managers have different fundraising and strategies. JP Morgan, their queue of capital, I think that says 12 billion, I'm sorry, that's a mistake. It's more like 4 billion queue for JP Morgan at this time, and they estimate it'll take 6 to 12 months to deploy that capital. So a little less time than IFM, but I wouldn't worry about that in terms of getting your capital deployed. For JP Morgan, though, if you do make a commitment, you are an investor of theirs for 4 years. Otherwise, you have to pay sort of an exit fee to get out, but we wouldn't envision you getting out. We hope you would stay in that fund. And in terms of investments, the other pages actually have more of a breakdown, but the JP Morgan, let me just flip real quick, I can tell you. JP Morgan fund has significant Europe and US exposure, then followed by the UK and Australia, so they don't have as much in sort of South America as Trustee Cromer sort of noticed, so it's a difference with their portfolio. So I would say IFM has investments in Mexico, Turkey, Peru, and JP Morgan has more investments in the US, Europe, Australia, Japan. So there's a little bit of a different geographic selection between the two managers.
Yeah, and we kind of talk about infrastructure as if it's one asset class, right? So sometimes I talk to you about the US stock market, and if I picked a bunch of stock managers, they would all look pretty darn similar to each other in the grand scheme of things. Infrastructure is more of a strategy, and the returns can be really different from one another. And if you look at the back of the book, at the returns, you'll see IFM most recently has had very strong returns. JP Morgan, not so much. Still positive returns, but probably, certainly not as strong as people had hoped, but still good. So one thing, and Jan also mentioned that they're big clumpy assets they buy. You buy a port, you buy an airport, they're big chunks of assets. So this might be an area where having additional diversification in multiple funds might be better, because we really don't, is IFM going to be the top one again, or is JP Morgan going to be the top one again? And the investments have a certain level of concentration in them. So that's something after JP Morgan and IFM leave, we can talk about, okay, well, how would we do this, if we want to do it? Do we want one or do we want two? Given the amount of dispersion and concentration within the vehicles.
And on the sort of performance numbers, the IFM performance numbers have been higher. And as I mentioned, they're in the US, in Europe, Turkey, Peru, Mexico, so they have a bit more, I would say non-mainstream countries where they're investing, which has also done well for them. They've had good returns from that. The JP Morgan fund is more invested in the US, in Europe, and not in some of those other countries. So there's a different country selection. Also, the JP Morgan fund has a significant amount of investments in renewables, wind and solar. And those investments are set up where they have guaranteed contracts to sell that power at stated prices. And so it's a fixed value. And so the value of those contracts is known, and it gives certainty to the return. It also hasn't benefited from appreciation across the sector because the value is known. You're not going to get more for that contract than is agreed, but at the same time, you're not going to experience a downward pressure on your revenues because it's fixed. So that is part of the reason for the difference in their returns. So as you look at building a portfolio, maybe a JP Morgan is more of a, it's going to keep you steady, and the IFM will benefit from appreciation. There's kind of two ways about it.
What kind of amortization is built into these personal property assets?
So that's a good question. A lot of infrastructure assets with very stable contracts have a higher amount of debt because they can service that debt with that known revenue.
I'm in amortization towards the depreciation of the asset. You build a solar plant at the end of 20 years, maybe 5 years, who knows, it's going to be obsolete.
Exactly.
And then it's going to be worthless.
Yep.
So
And
it's not like you buy an office building and at the end of 30 years, well, you may have to renovate it, but it's still there. And a lot of these kinds of assets, they're not worth anything, they're scrapped at the end of a short period of time.
Sure, no, and that's a good point. The value of those assets is based on the value of the contracts for people to take that energy. And I think back in the day, people would say, oh, that solar farm is going to be worth something after that 25-year contract is over. People are getting more conservative. They say that solar farm is worth what I have on the 25-year contract. We that time, we're not putting value on it.
Who's cutting the fat hog on the depreciation of these assets? We can't utilize the depreciation.
Right.
So are these partners, these GPs, are they taking that depreciation?
I don't know the answer to that question.
Because
So
if
that's
they are,
something-
their fees,
That's something that
Yeah,
I
they should be
encourage you
paying
to
us.
ask. Yeah, I encourage you to ask them about how the financing structure. Sometimes they have
it's not
financing
the finance, it's
structures.
the tax benefits from ownership.
Well, people get the depreciation kind of as part of their ownership. There are tax credit partners and things like that, so that is part of how these deals may be financed. So somebody is maybe getting that benefit, but that's part of how these farms get their financing. So there's some trade-offs there, I think. But definitely feel free to ask that.
So is it to say that you gotta ignore their other deals and focus on our deal?
I would say that when they build these solar farms, they need to have financing. And so they go out to the market to get the best financing for themselves, and it may require having somebody be the tax equity partner to get that benefit, but it helps you with your overall cost of financing.
So you have 31% for IFM and 53% leverage numbers in
On the
that chart.
portfolio.
That's what we're talking about
Yeah.
now.
Yeah.
I have a question here. It's on 31 of our slides. Can you explain the difference in the approaches between IFM and JP Morgan, where there's a 33% catch-up and 50% held back each year for
Yeah.
their performance, and the other one has no catch-up, but then they get 50% of performance fees in excess of the hurdle?
Yep, and so with private, private investments, there's an incentive fee that says if the manager gets over the hurdle amount. So for IFM, if investors get an 8% return, then IFM, the manager, gets that 10% of any excess of that return. And then, I have to go to footnote 2 here, they don't pay that excess out 100%. Immediately, they hold back 50% of that to the next year to make sure the fund is still continuing to perform. And then IFM is allowed to catch up and get some of the additional return after the investor reaches their 8% hurdle. Stay with me here for a minute here. The JP Morgan investor hurdle is 7%. So an investor is guaranteed a 7% return before JP Morgan collects any incentive fee. So that means IFM investors are guaranteed 8% before
You're using that
IFM.
word guaranteed, that's a.
Thank you.
That's a very sensitive
The
word.
investors have to get 8% return before the managers can collect any fees. So if
Additional
you,
fee.
yes,
Yeah, incentive fee.
thank you,
Yeah.
keep me honest.
Yeah.
So when you look at that, IFM, maybe they take a little more risk because they have to get the investors 8% before they can collect any fee. Or maybe an investor thinks of it as, I'll get more return before the manager starts to share in the profit with an 8%. So that's a slight difference, and they're two different fee
Approaches.
structures, I would say. And then JP Morgan has a limit on how much performance fee they'll collect, up to 13% of maximum excess performance. IFM doesn't have that same limit on there, but the investor gets 8%, will get 8% before IFM is allowed to collect any profit.
Are these managers participating in these as well?
In these funds, IFM is owned by pension funds, and so the owners of those pension funds are invested in here, so they participate in the performance, and then they participate in the fees that are collected. JP Morgan, the team, gets part of their compensation from performance of the fund over the long term.
So, I'm not exactly clear on that.
But it's
Are
not.
they
just dollars
investors?
invested.
JP Morgan has some amount of capital invested in the fund to align interests.
How much is that? Do you know, I should ask them.
If you'd ask them, they might have the latest data on that, yeah. I believe it's, I have something of 5 million, but I don't know if it's an updated number, so I'd like to ask them that, yeah.
So there's a chart, comparative manager performance, that it's got dashes on JP.
JP Morgan, yes, they didn't provide the difference in income and appreciation in time for our cutoff date for this package. So, we didn't get that information from them. But during the meeting, if they don't say it, I'll be sure to ask them, how much of their return has come from income, steady paid out versus appreciation over time.
So,
Are we ready to get started?
Okay. I think
JP
we are.
Morgan's here, but IFM is not?
Well, IFM is, we gave them, they're not supposed to be here until 10:15.
Oh, okay, okay,
Yeah,
so
so we
JP
tell
Morgan's
them-
up first.
Yeah, JP Morgan
Okay.
9:15 and then
Okay.
IFM 10:15.
All right.
I'll ask one more question. So what's the difference between these guys and a REIT?
In a REIT.
Real
Well,
estate investment trust, or kind of or a hedge fund, that the hedge fund, instead of investing in stock, they're dealing in what they want to call infrastructure deals. So they're doing kind of real estate deals, personal property. I mean, they're basically hedge fund managers. They're just cooking up deals that they can call infrastructure. Some with financing, some with not financing. It's kind of a pretty broad.
I think one of the differences is that these two firms are owning and operating their assets, and they're involved in the day-to-day activities at these assets. They either they always, at a minimum, have board representation for a company that they own to be involved in key decisions that are being made and operational activities. A hedge fund manager, I don't know that they have as many people involved with the operations of an asset that they
I
own.
put people on the boards.
They may, I don't know what kind of control rights they have. Both of these managers are involved with the direction of the operation of.
I'm just trying to,
Yeah, no.
I'm just trying to call it what it is. You know, I mean, not being negative or positive, it's kind of strip away the fancy talk and get down to, you know, what these businesses really are.
Yeah,
And
so a lot of times when you hear hedge fund, you think someone who's trading public market securities and having a long-short strategy on public securities and often have leverage and a 2-20 fee structure. To me, the word hedge fund is actually, I don't even know what that means when you say hedge fund, right? Because it could mean like 50, it could be distressed debt, it could be all these different things.
that's my point.
And then you look at like what's a real estate manager for our core open-ended real estate funds. We've got a couple in the investment program. They go out and they buy real property, and you are then an owner of a real estate building indirectly, and they might borrow money to buy that real estate building. And so our core open-ended real estate funds, we invest in our 20 to 30% levered. And then this is a little bit closer to real estate in that you're investing in this private investment vehicle, which will then go out and buy some form of private assets. And with the theme of it being infrastructure. And it can be roads, it could be wind farms, it could be cell towers, it could be utilities.
They're assets that do something
And
versus a building that houses, you know, it's kind of a fixed item. You know,
Yeah.
you can picture an office building or industrial building.
Yeah.
But infrastructure is kind of a mix of, it's like making a loan on a gas station. Are you making a loan on a real estate, or are you making a loan on the
Yeah.
business of the gas station?
But you would be buying the gas station. You own the gas station.
Right.
And the gas station has a couple components to it. It's got the real property, but it's also a company that sells
Right.
the gas.
It's a business, and without the real estate, neither one,
What can you?
financing gas stations is one of the hardest things for bankers to do,
Yeah,
because they're not one or the other.
right.
And the mini mart.
Well, yeah.
Oh, boy, yeah, both of those,
Yeah.
so it's not- yeah.
Yeah.
But both of these managers own airports, right? So not a gas station, but the airport has certain, we can't just pick it up and move it, right? So it has a certain defensible.
Right. But
service
these
that it
assets
sells.
are pretty much combination assets, where you've got the underlying real estate and the functionality that goes with it that are inseparable from each other.
Now, technically with San Francisco, I don't know who owns the land of San Francisco Airport, right? But you might own the airport, right?
Right.
So there are a lot of million of details in this, but we knew there was a little bit of question, okay, what is this thing, infrastructure? So what we've instructed the managers to do today is come in and spend the first 30 minutes saying, in their world, what is infrastructure? And so if you actually invest in this fund, how do we define this? What is it?
Right.
So their first 30 minutes is supposed to be educating you, both of them. And then the next 30 minutes of the presentation is, why are we good at doing this? So hopefully during the first 30 minutes for both of them, they'll be able to really drive it home, okay, this is what this investment would look like with us.
And just like REIT managers, if you're gonna hire REIT, do you invest in making loans on Walmarts that are owned, privately owned Walmarts, or do you invest in post offices, or do you invest in office buildings like yours in San Francisco, or
Yeah.
do you, so you, as the board,
Yeah.
the important thing is what are the guidelines? If you're gonna make loans, you're gonna make home loans, you're gonna make loans on office buildings, you're gonna make loans, So you pick the manager that invests in the assets, because that's, when you get right down to it, it's the underlying asset that you really care about. So picking a manager that buys the flavor of ice cream that you like.
And one thing I'd say about these two managers, the reason we brought them in is the number of open-end infrastructure funds is much smaller than the number of open-end real estate funds out there. Open-end real estate funds started, I think, in the late 70s, and they've had more time just to expand. Open-end infrastructure, these are two of the longest-running managers, starting in '04 and '09. And so these two have a larger portfolio than any of their peers in the market, which means it's more diverse, more assets in there. So you can see and understand what they think is infrastructure. There are other managers out there, but they're newer. One of them has one asset. It's a little too early, we feel, to look at those. So I did spend a few minutes on why we brought these two managers in. These are the experts in the open-end infrastructure space.
Well, I see that big top line number of trillions of dollars, but then the second or third line down is like 25 million, or, it's not the JP Morgan number, it's the actual fund number.
Yep.
And there, is that, I forget what they are, but they weren't that really big a number.
They're about, these two funds are about, IFM's closer to 20 billion, JP Morgan is less than that. JP Morgan's about 15 or so.
Was that billion?
Billion.
Oh,
Yes,
okay.
in total
Okay.
value of the investments.
Yeah, so the fund
It's
would go
MST.
into,
Okay,
yeah,
okay, no, yeah, no, they're
Yeah,
more
no, not a-
substantial than that.
these are big funds.
Could, really briefly, would you contrast for the board buying into one of these or buying PG&E stock? As what's more volatile, what can we track better?
PG&E
what's
is
a long-
tough with all the.
Well,
reasons.
call it
Any-
okay,
any
electric
stock,
utility.
Sure.
How's that?
Washington Power.
There you go, Washington.
So to make an investment in one of these two funds, you will get exposure to more than one sector. You have transport, utilities, data centers.
I guess on the risk basis, focus, if here's
On
a
a
risk
risk
basis comparison.
Well, I mean, with PG&E, that was one stock, right? And if you had your entire, we'll call it a 10 million allocation in PG&E, it wouldn't be a great story.
And
at this point.
$45 in deficit.
Yeah, so so it's kind of unfair to pick on them in a way, but if you pick just one stock, you are wedded to the fortunes of that one company. Here, with these two managers, you were gonna get 15 assets at a minimum, and then you have the various underlying companies that are producing revenue. So you have more diversification across the sector. These two managers are investing in multiple regions, multiple countries, so you have diversification. If you had invested only in a UK-based utility, they're having some issues there right now with regulatory and Brexit, so that wouldn't look so good. So because you diversified across geography and sector, we would hope you have a more, long-term appreciation of real assets and a little less volatile than a single company or even single region. So one other aspect of these funds to consider is that they are investing outside the US as well. So you have some diversification of your portfolio on a geographic basis. Right now, the US dollar is strong and I love it, right? But some people aren't sure how that will go in the future. And so some people think having international exposure is actually a good long-term thing for a portfolio. So,
Thank you.
yeah.
If we go back to your core, your chart with core,
Yeah.
Core plus
Core
opportunities.
core plus opportunistic,
Mhm.
and the yields that you should expect on those,
Mhm.
which one of these silos do we put infrastructure, and do those returns match? Does the risk reward ratio match those silos? So which silo would you put it in?
This one I would say is a core plus type of investment because you are targeting 8 to 12% or 10% over the long term. A core investment is going to be maybe 5 or 6% return. So I'd say you're getting a little bit more. So I would say it's core plus. And in terms of the income, both of these managers, I think, are targeting around 5 to 6% income return on an annual basis that the pension fund could collect and keep. sort of take some chips off the table, or you could say, I want to put that back in and have that go to work for me as well in the future. So a lot of people have been attracted to infrastructure for that.
Does risk put them in core plus or return? I guess my point is, are we getting paid appropriately for the risk of investing in wind farms and in assets? Are we getting compensated correctly for that?
I think, based on looking at the infrastructure universe where you could invest, I think this is a reasonable risk and return. There are other things that promise more return, but you have to lock up your commitment for 10 years, and you have no flexibility on timing of when you get out. And we've seen other funds kind of a similar size managing that, what we call reinvestment risk. You make your commitment, you don't know when the money's coming back, so you don't know when you have to redeploy it. And then there are other things the board focuses on that make it hard to stay on top of that, frankly. And so we found in the real estate sector, these open-end funds provide our clients a great way to get exposure to the asset class on an ongoing basis and benefit from long-term, capital appreciation trends for real assets. So we think it's a really interesting way for our clients to get good exposure. Sometimes you buy an investment like an airport in a closed-end fund, and then they sell it, and your next manager just buys it again, and you pay more, you pay the transaction fees. Here, you get the asset and you go with it.
But if you buy an office building, you buy it on the income stream. So, you're gonna capitalize the income stream just like you are at this and come up with a rate of return. But at the end of the rainbow, you have appreciation built in. Well, you have, depreciation and appreciation. And if you maintain the asset, you've had that built into your, your pro forma all the way along, you're gonna have a new office building at the end, at the end of 20, 30 years, it's going to be in new condition. It may be 20 or 30 years old, but you've maintained it properly. And so at the end of the rainbow, you have appreciation built in it. You bought this office building 20 years ago and you maintained it properly. It's worth a heck of a lot more than it was 20 years ago.
Let me
So if we get into these.
Only if you could rent it out.
Yeah.
Only if you could rent it out.
What do we have at the end of it, other than, solar panels?
Oh, no,
that are-
solar is a different
So,
thing. Other
yeah.
assets are longer lived.
Yeah, so, we like real estate, and you've got real estate.
Mhm.
And this is a little bit different. So we'll have them come in, and the first 30 minutes, they'll talk about their portfolio. Okay, what do you have, and why is it good? And I think they'll kind of bring it to life a little bit more.
Yeah.
Not all of this is, is it a real property at the end of the day, but not all of it is a real property at the end of the day, but a lot of it is. So it's what time is it? It's about 9:30, and we had them scheduled coming at 9:15. So I'll go grab them, and they'll spend the next hour with you, going over kind of the schedule that I described earlier. So I'll go grab them and bring them JP Morgan.
I'm part of a group that has a really nice conditioned old building we can't get tenants for. So what's the value of that?
You could buy a fully leased Walmart. Hey, what a great idea, except it's in Podunk, Tennessee, and Walmart said, we're only making 5% on this. Yeah, we're leaving.
We're leaving. I get it.
Oh my gosh, and who's gonna go in after that?
Do you want me
Yeah,
Oh, yeah.
that big of a building.
Well, not only
Unless you get
did
a
it
Costco
destroy
or
the
something,
town.
and you just rent.
So now they're vacating a town that they've already destroyed by,
Yeah, that would be
that's
nice.
a real big issue, like in these little towns throughout America where Walmart, and the worst thing is they're making money on those stores. They just go, we're not making our target, so we're just pulling out.
They got us ahead of schedule.
Have no
Your
social,
sales tax base, I mean,
no social
everything.
responsibility at all in some of these arguments.
Hi, good morning, everyone.
Good morning.
We're shifting around here.
Oh, no worries.
You guys can change.
Oh, here, sure.
No worries.
You have a little table
Put the camera on her.
Does anyone need books?
Nope, we're good.
Okay.
We have your stuff? Fire away. You may want to introduce yourselves.
Yeah, absolutely. My name is Sean Paris. I work for JP Morgan. I'm a client advisor. I work with a lot of pension funds, so we've been doing this for some time. I'm here with my colleague, Dan Galinko. Dan is an investment specialist on our infrastructure team. He's going to go into a lot of the details. Our plan today is to start out just giving you some education on infrastructure. I know there's so many different facets to, infrastructure, real estate, all these different areas. So we thought it would be best if we kind of go through some details on that. Then we'll go into more details on our fund and why we think we're the better candidates. I'll kick it off to Dan.
Thank you,
Go
Sean.
ahead.
Thank you for your interest and time this morning. I would just also say that if you have questions, don't be shy. It's more fun as a conversation, so.
Absolutely.
Yeah, so look, maybe from the top, infrastructure is really just essential services for local communities. As you think about what an infrastructure asset is, it should support very essential services for local communities and or be the backbone assets for local trade, for the economy generally. So I think classically imagined, in the way that we think about infrastructure assets, they're a benefit to invest in because the demand profile for infrastructure services tends to be the same regardless of where you are in the economic cycle. And so to a very basic level, water and wastewater services provided by local utility, electric, home heating, energy, power generation are obviously essential services. People are going to take the same number of showers, hopefully in the booming economy as they do when there's a recession. And being that these are very essential services, you tend to get very stable, predictable return profiles out of these businesses. They carry a few benefits. Generally, the first is, again, they don't really behave like the other assets in your portfolio, be they equities or fixed income. They're providing high levels of income. So the predictability of business plan and the predictability of the services provided are matched by very predictable income streams that are yielded out over time. And probably the other major reason that investors invest in infrastructure assets is not as much of a concern today, but inflation is something that's peaked up from time to time that we've been concerned could impact our overall investment portfolios. And what you tend to see out of infrastructure assets is that the returns are hedged against inflation scenarios. So from a very basic level, if you think about that local water utility, if the cost of running that business goes up, if your cost of borrowing goes up, the bills automatically adjust. So the customer bills go up to reflect that change in the cost profile of the business. And in doing so, the returns on infrastructure are hedged for inflation. So again, inflation is very low today, so it's not as much of an investor concern, but these are the basic reasons that investors come to infrastructure generally as an investment asset class. So, turning to the pages, those three facets are highlighted on page 4. And if you look at the numbers generally, we have a little bit of the math on slide 5. So JP Morgan, obviously we have the benefit in the broader organization of a lot of good research, and they set forth their capital markets assumptions each year. And one of the things that we're seeing now is that there's concern that we're late cycle. So we've had a long expanding economy. So could there be volatility in equity markets going forward? We've already seen some volatility. Return expectations for equities are generally depressed over the next 10 to 15 years. And furthermore, interest rates are very low. So the income that long-term investors like pension funds and insurance companies have relied on for a long time is being squeezed. So infrastructure generally, with this promise of a less volatile earning stream, less volatile cash flow over time, and inflation hedging if it becomes a concern, and very stable high incomes, has been generally an asset class that's been popular for long-term investors, particularly as of late in this point in the cycle. So we've seen growing overall appetite for infrastructure assets, and we have some of the data in the book, but generally speaking, there's been really a proliferation of different strategies that invest into these types of infrastructure assets via all kinds of different strategies, and it's generally been a way for investors to diversify from equities and fixed income to put a little bit more ballast into portfolios overall based on those underlying characteristics of the businesses. So again, what we see here from the math and the way that we sort of think about infrastructure is that we measure risk and think about risk mitigation in the context of income. So rather than think about risk against total return, we think about yield. And to the extent that an infrastructure asset could put cash in your pocket every quarter, and most of your return is actually coming from that cash yield, it's actually diversifying you away and enhancing the overall return experience for the portfolio. So really, those are the reasons that investors have been coming to the asset class. And again, we could delve a little bit more into the specific characteristics of the assets and what makes them able to deliver those types of return profiles. Maybe I'll pause there just because I've been talking and see if there's
Any questions?
any questions that have come to mind. Sure. So moving on to slide 6. Obviously, this is a little bit of how we think about the infrastructure market and what we would define as a core or core plus risk profile. We set this out as to really classic infrastructure sectors, which I mentioned before, but the left in blue is distributed and regulated assets. And again, these are, back to my prior term, essential services for local communities, the need for stable electric services, the need for water and wastewater services, and the energy used to power local businesses and heat local homes and local communities. So we think those are very core classic infrastructure assets. The middle, we deem the contracted assets. Largely that's power generation. So you're owning renewables or natural gas fired generation, other types of generation technologies, and selling them under very long-term contracts to utilities or other buyers of power. So really what you see out of those types of assets is a long-term contract with a creditworthy counterparty. I think there's a temptation to think, and it is true that you see power prices can be very volatile over time, and there's probably a bifurcation within the types of power assets that you can invest in. Some are under long-term contract that do not take commodity risk, while others are under different contractual arrangements where there may be more exposure to power prices going up and down. So within a strategy like ours, we're very focused on the types of assets that have a long-term contract where a creditworthy utility is buying the power under a 15 or 20-year purchase agreement, and they're paying the power station to be available to deliver electric, regardless of where power prices are or where commodity prices are. So very, again, essential services that support electric power in local communities. And lastly, GDP-sensitive assets. These are, again, what you would classically imagine as infrastructure. It's airports, it's logistics facilities and other ports that support local trade, support economic activity, and or the movement of people, passengers, and goods. So again, they tend to be monopoly assets. They tend to have either very large corporate customers or individuals that are patronizing the assets. And again, by virtue of them being essential to local trade, they have a little bit more exposure to the economic cycle, but also can have a high component of predictable cash flow if you have blue chip customers using your services. So that's a little bit, again, on the definitional aspect of the types of assets that we consider under the infrastructure umbrella. and that we try to incorporate into our portfolio. Again, on slide 7, walking through, we have a little bit of the third-party data in terms of infrastructure adoption within private investment markets. So again, we've seen growing, so first there's clearly a lot of need for investment in infrastructure. From a US perspective, we spent really a generation not making critical investments into the integrity of our infrastructure assets. And obviously, I guess I don't have to tell you here in California, there's been issues with integrity and sustainability of the power and utility systems. But there is clearly a huge need to invest in these systems and create long-term sustainable business plans for them. And so the overall amount of investment flow has gone up, and there's also, because of the attributes we've discussed, there's been a lot of interest from investors to participate in these assets via private markets. I think it is an interesting, it's a bit of an academic pursuit or thought on the asset class, but and we're biased because we're private markets investing in private businesses, but we do think there is a debate over being very focused in the public markets context on quarterly earnings versus being in the private markets where you can be very focused on a very long-term business plan. So I do think setting goals and good business outcomes for these assets really is measured in 5, 10, 15-year increments as opposed to quarterly objectives. So I do think that within private strategies, you find a lot more very long-term business planning within these strategies, which could be helpful to overall total return and predictability of return over time. So that's one of the things that I would emphasize, and clearly it's become a more popular area of investment for pensions.
Sure.
So with an investment in something like transmission lines, how does that fit into a portfolio? Because if the goal of portfolios get 6-7% return, and if that's a regulated industry where supposedly the utility is only supposed to earn maybe 4%, how does that fit into the portfolio?
So it's a great question. Actually, it goes very well into the next slide we have in the book. And one of the things that, so yeah, certain areas of infrastructure are very tight in terms of overall return, depending on what the allowance is from the regulator to earn on those businesses. So there's not great data in private infrastructure in terms of what returns look like. We have some data. We don't promise big data, but some data. And what we've seen, so what we have here is, the sum is that we find these businesses to be spread businesses versus the risk-free rate. So the returns on core infrastructure assets like transmission lines, like essential service utilities, tends to be a spread over the risk-free rate in the economy. So the regulator will allow you to earn some spread over the risk-free. So we've seen risk-free rates decline. So those are the bottom purple, gray, and blue lines. Those expected, so the baseline returns for economy have gone down over time. And we've also seen the expectations for those transmission lines and other like businesses have gone down over time. That's the green line, dotted line on the top. The interesting thing though, is that if you subtract those two numbers over time, the spread has actually been relatively consistent. And you'll see a little bit more of the numbers in terms of the total return of this portfolio. But we do think that overall, that spread has maintained relatively consistently. And we've seen that through the actual returns in our fund. So about a 600-700 basis point spread over risk-free rate should be the return of those types of assets. And we've actually seen that sustained. So again, we're in a zero interest rate, zero inflation environment now. So we would expect to be 600 or 700 basis points over zero. But again, someday we might have rising interest rates, we might have rising inflation, in which case that overall return expectation should track up again. So a little bit of a long answer to your question.
Let me ask a different way. So if you were given the opportunity to buy transmission lines where you make a 4% return, would you buy them, or would you let someone else buy them and you would just pass?
So 4% is too low for us.
Yeah.
So the yield on this fund has been Well, the target is 5 to 7%. We've been at the higher end of that over the last 5 years. So really an asset that's returning 4% would be dilutive to the overall experience. And we have found a lot of other opportunity to invest in assets where the expected yield is much more in that 5 to 7% range. So very specifically to...
And just to make sure we're clear, yield and total return are two different things, right?
Exactly.
Okay.
So, and it's an important distinction to make, as ultimately we think that the best way to constrain volatility in the total return year over year is if most of that number is actually coming from cash. So you're underwriting to the expected yield being most of your total return with a little bit of capital appreciation based on business plan or rising inflation or other pass-throughs. So generally speaking, we're trying to get most of the return from that cash.
Cash flow.
Cash flow, yes. So ultimately, if you imagine a utility, they're going to have earnings, so there'll be revenues from customers paying their bills. There's a cost structure, debt, obviously the service, and excess earnings from those businesses. We like to dividend out and pay out in the form of yield to investors.
So to be clear, if you have a power, so on the one hand, you're saying that these are inflation hedged to some degree, and yet on the other hand, you're saying that you prefer to, if you have transmission lines or generating power, that you're going to sell those on long-term fixed contract. How do you have that both ways?
Sure. So that probably brings into so as you turn back to slide 6, the interesting thing within these businesses is that as you think about the diversification, inflation protection, and yield goals, one of the benefits of having a diversified portfolio in terms of sector and subsector is that each subsector contributes to those goals differently. So as you think about a utility, they tend to be very stable over time, so you don't get much of this in terms of the earnings. You get inflation protection and yield.
How do you get inflation protection if you're selling at a fixed price?
Well, so the utility, so regulated utility, the regulator, usually under a 3 or 4, 5, 7-year plan, is giving you a return on, they basically set your expected costs and they set the revenues to make a certain rate of return. So they might set a 9% return, and revenues are adjusted to reflect maintaining that, including inflation.
So rather than having a CPI, cost of living increase contract, you're at the mercy of regulators looking back and saying, gee, we in spite of all these people from San Francisco with pitchforks, we're going to give you more income on your lease because we like you?
Well, so generally speaking, the way, and each regulatory construct works a little bit differently. So the good news for a large portfolio is you don't put all your eggs in one basket with just one regulator in San Francisco or elsewhere, diversification. But generally speaking, regulators have a tough job. They're trying to make sure that infrastructure is in a good, safe, environmentally compliant state of condition for a long time. They're making sure that there's affordability. And there's making sure that, so really a fund like ours has to focus on social contract. So it is working constructively with regulators to make sure that the assets are in a good, stable, safe condition. We're responsive to customer concerns and are delivering what's needed for local communities. So
you trust government?
Well, look, in some respects,
Okay.
yes. So
We have to.
Trust in God. That's okay.
Let me ask it a slightly different way. So let's say the CPUC here in California approves increases in rates for your utility bill. If the cost to do business goes up for the utility because of inflation, what they pass on to ratepayers goes up as well.
exactly.
So that's where the inflation comes through. If your costs go up because inflation is higher, you can then pass the cost on to your
I'm just saying
client.
it's not in the contract. It's
Well, so the explicit
It's in the
regulatory
social
mechanism.
contract.
Yeah.
Well, but so the regulator will give you, for the next 5 years, a regulatory plan that includes the revenues over the very detailed, so when you go for your rate case, it's a very detailed exercise to show all your costs of borrowing, and inflation adjustments that gives you a very regulated rate of return on those businesses.
Not to get too far into the weeds, but
You already did that.
Too late?
But if PG&E gets a rate increase, how does that relate to the person that owns this power line? Where's their obligation to pass that on down the line?
Well, so,
Where's the linkage there?
sure, so, again, it comes back a little bit to social contract. So, I'll give you a live example from the portfolio. So we bought a mature gas system a couple of years ago in Arkansas and Oklahoma. So a very stable, old utility that's been delivering gas to homes for a long time.
So it's a retail system.
It's a retail system,
Okay,
so
because
customers.
there's a difference between wholesale and retail.
That's also true. But I think it is a good example for how businesses tend to work in our portfolio.
Okay.
So the challenge in that community, so we bought into an asset that's delivering gas to homes and businesses. And the regulator is focused on making sure things are affordable for customers, but also the pipes are very old and safety issues are increasing. And they are wanting investors like us to come in and say, we will commit to pipeline replacement over the next few years. If you put X dollars into doing it, we have to agree to a budget. We will give you an accelerated return on that capital by adjusting the customer bills to reflect that work and incentivize that work. So in a place like that, so before we bought the system where they were replacing about 2 miles of old pipe per year, this year we're going to do 43 miles. And the regulator is allowing us to return on that capital that we added to the base investment. So for us, we do believe in the need to invest in these systems. We think that there's a constructive role to play. And we get a very regulated, stable, predictable return outlook that's supportive of the yield and overall risk tolerance of a fund like ours. So that's by and large how a lot of the regulated assets work in the portfolio.
So to fire up the weed eater and to stay with your retail gas company, you were buying wholesale gas to put into those pipes, correct?
Well, we're not necessarily purchasing it. We are essentially,
It's like Sonoma Clean
we
Power,
own the highway.
right?
So
Okay.
we don't own the cars on the highway.
Yeah.
We own the highway and people pay to use it. So we're being paid on the usage of that
Okay.
system. Our obligation is to make sure that it's operated safely, and we're fixing if there's an outage or.
So the trucks driving on your highway are owned by somebody else,
Correct.
and those people are buying long-term wholesale contracts for natural gas.
Right.
So basically, what you're doing is maintaining a system, they're furnishing the product to your system.
Yes. So as you think, when you pay your electric bill, you're paying for the megawatts, the kilowatts.
Right,
that you
and
use.
the reason I talk about wholesale retail is there's big power generator transfer systems in California that PG&E doesn't own. And they buy 25-year contracts, which I thought is where you were going.
But if inflation kicks up, nobody has to pay you more for the use of that pipeline, because you don't have a CPI adjustment in your,
Well, so that,
unless you do.
so that gas utility has CPI
Right.
adjustments.
So the product
So
that
the-
moves through it is a different thing from
That's-
what they're
yes,
doing.
Exactly.
Okay.
So the utility itself is getting the inflation adjustment, but you're correct. So in the middle category, if we own the power plant, those revenues don't necessarily adjust as quickly for inflation. So you are a little bit more exposed on the contracted power side to inflation, but you have very long-term contracts and very high cash yields out of those. So those contribute to the cash yield. And then bringing it all the way home to GDP sensitive, you're getting a little bit less yield, a little higher expected return, and inflation adjustment because many of the contracts themselves with the customers are indexed to inflation. So again, you get a soup that's got a little bit of different contribution from each of the categories, but therein lies why go into a diversified fund that has different drivers and different businesses. So anyways, that's a very, hopefully good overview of kind of how the infrastructure businesses are working. Happy to take any questions on that or move into.
I think that's great. So maybe, if you start talking about the fund on 11, I think that'll continue to bring it to life a little bit.
Sure. So again, we are IIF. We are a core plus focused infrastructure manager. We have an open-ended fund, meaning that we are building a portfolio over time, our goal is to own assets very long term and cash yield them over time. So again, most of the return from the yield, we're targeting an 8 to 12% total return, and 5 to 7% of that should be coming from, again, the cash yield. So cash stable businesses across the sectors that we've discussed. And the beauty of the open-ended structure is that we've been building this portfolio since 06, 07. It's very large and diverse today. So new investors coming in, we're using your capital to further diversify the overall asset mix. And you're getting immediate exposure to a diverse set of assets. So today it's 19 companies, over 450 assets that are owned by those companies, and quite good diversification across market and subsector. So really good mix of assets that today, by virtue of how we built it, are distributing a very stable, predictable cash yield. So again, you've seen that grow over time. The yield is 7% over 5 years. We're 8% on the trailing 12 months. And that cash that we're distributing is coming, sure.
This is taking us back a little bit, but on page 7, I see your chart where there's this, it's more than doubled since 2007 about the infrastructure investment need.
Yes.
And then on some of the information we received from Callan, it sounds like it's a 6 to 12 month delay for new commitments being called. And what's the reason for that delay?
Sure. So we're out in the market looking for new assets to further diversify the overall mix. And look, we have to be cautious and patient in terms of putting capital to work. And picking the right ones that are accretive to the overall returns of the fund. So, look, we've been raising $2 to $3 billion per year of new capital from investors and deploying about the same amount. This year we're a little higher at $4 billion of new capital formed or raised, and we've been cautious in terms of the deployment, given that we want to maintain discipline on how we're buying assets and valuations, cash yields, et cetera. So I think the 6 to 12 month wait is hopefully a sign of general conservatism in terms of how we're spending that new capital.
So it's more reflective on the caution that you use and selectiveness and what you're investing in.
Exactly.
Because it seems to be an industry standard, it's not just specific to your company. Almost all the other infrastructure companies that we're going to talk to today have potentially even a longer delay.
Yeah, so look, and a little bit more in the weeds in terms of how we're deploying capital this year, but there have been many instances this year where we're a credible buyer of assets. We work well with local communities, et cetera. We'll be the final two for bidding, and we'll lose by 25%. Chances are that winner is putting more debt on, and we say good luck. If you can't get the debt, our price is still valid, maybe a little lower. So we've been very patient this year in those situations, and a couple of those are calling us back today. So we'll see if about deploying capital into the end of the year or the beginning of next. But again, we're trying to be very cautious, and ultimately investors have given us their trust based on the consistency of the cash yield. If we spend money just to spend money and be competitive in those, the yield will go down, and you won't want to hear from us at that point. So again, we're trying to stay very disciplined in terms of valuations.
So is that investment need continuing to rise because of new technologies, or is it because of old systems, or is it just because of developments?
So it's a mix, all of the above. But
Okay.
again, we've been pretty bad as a country investing in the integrity of infrastructure assets. So the amount of capital that's needed to support those systems vastly outstrips the amount of capital, and it's finding the right ones in the right situations. Again, there's a lot of states in the US where we would not put capital to work because the regulation is not as supportive for private capital. But again, it's choosing the right situations and being selective on how we're putting capital to work against that need.
Would it also be fair to say that you're replacing what was government financed projects with private funds?
So
Governments aren't doing things, so but passing, private freeways and things like that.
So we don't like to buy things from the government. We don't really do that. Usually the first buyer has a tough time with it and getting the regulation right. Look, there's a big effort afoot to privatize US airports. It's taken a long time to get going. It's hard to buy from the government. So usually we're buying from a public utility. So, public.
New roads.
Yeah.
Government doesn't build new roads anymore. They look to the private sector to finance what used to be paid with taxes.
Yep, that's true. And there's a big tax advantage because it's tax-free money to do a lot of the municipal financing. We tend not to do any of that. At the end of the day, building something, so if we're going to spend a lot of capital before it's cash flowing in a greenfield, again, that dilutes our yield. So we're very focused on brownfield. So existing assets, usually we're buying those from other financial investors, from the public market, so public to private in some cases, or other types of assets that are already in private ownership as opposed to government ownership.
Like the pipeline you're repairing.
Yes. So overall, the two other high-level points that I would make, again, it's very classic infrastructure sectors, so you don't see us doing things that we're not good at or we don't understand, like data centers or otherwise. We're shying at this point in the cycle away from the more GDP-sensitive assets. So we do think that if we go into a cycle, there could be volumetric risk or other types of risk on very GDP-linked assets. So really, we want that to be 20% or less of the portfolio, and we're on our way to getting it there. The other piece is that, to your question about government and regulation, we want to be focused on jurisdictions where we know the regulators very well, they have a good reputation, not going into the emerging markets. We're very focused on places that we understand in OECD developed markets. So it's really the US, Western Europe, the UK are the majority, and Canada and Australia are the majority of the capital. So a few things I'll emphasize. So again, long-term is really important. Going on to slide 12, and I'll try to go through some of these key points efficiently, but a few high definitional in terms of how we're putting capital to work. We love control. So we want to be able to hire and fire the CEO, set his incentive plan. So we have to buy 100% of the business to be able to do that. And it's very important to have very good governance structures around these businesses, have representatives on the board that have regulatory backgrounds, that have direct industry background, and can support management teams on very long-term business planning. So again, we're measuring outcomes in 5, 10, 15-year increments and focusing the businesses through governance and control on those objectives. Important as well that those boards, we really like to have them diverse in terms of thought and experience. So again, it's not just New York finance people sitting on the board of a company. It is people that are in the ground, that are out of communities, that have labor experience, that have experience in those communities, that can give a diversity of thought and help guide the businesses and make them more supportive of local communities. Why don't I go on to team a little bit? So slide 13, JP Morgan's a very big place. But the 50 or so people that work on this team only focus on IIF. There are no other infrastructure funds, no separate accounts. Everybody on the team only focuses on this fund and making it successful every day. So we have in-house client service team, in-house legal, tax, finance, et cetera, so that we're, within JP Morgan, a very insulated group focused on the total returns of this strategy. I will move on to slide 15. So hitting some of the high points here. So I'm biased in saying it, but as you think about core private infrastructure portfolios, I would say that we're the most diverse in the market today for funds that you're looking to purchase into. And again, that goes to the number of companies, which are represented on the left of the page, and the overall diversity of geographic exposure and subsector exposure. We want to make sure that no individual risk in the fund is too great, making for systemic risk. So no one regulator, no one area of solar irradiance, no one government, et cetera, drives too much of the value of the fund. So diversification gives both us and our investors the sleep at night risk. And again, as we bring more capital into the fund, we continue to focus on diversifying overall exposure.
Any concerns with Brexit?
Yeah, so Brexit, we have taken steps to reduce UK exposure over time, not just right now because of Brexit. So you'll see over time we've dramatically reduced the overall exposure to UK. But the immediate impact of Brexit, we don't expect. We really think it's a longer term GDP impact to the country, which ultimately affects customers' ability to pay a bill. So we've been reducing UK exposure for a number of years now.
So who and where is Ventient?
Ventient is a pan-European wind power business. So they have a large portfolio in the UK, plus Spain, Portugal, France, Belgium, Germany. So it's a very large company. We have a CEO at the top. We own 100% of it. And we are managing a very large-scale wind power generation portfolio. It has an independent board around it. They are acquiring assets and incorporating them into larger operating portfolios, which brings a lot of benefit. Ultimately, what's interesting about having a scale platform business like that is that, for example, we use a lot of Vestas wind turbines. By virtue of having a very big business, we have very good negotiating power against Vestas to negotiate long-term service contracts, access to capital markets, et cetera. So actually, running scale businesses, it's an important concept in our overall investment strategy, but we like to build businesses like that, where they have scale, can incorporate smaller assets into bigger portfolios and drive outperformance against target.
Dan?
Yes.
You talked about your strategy as a buy and hold for cash flow and all of that. Do you ever divest of assets? You ever sell anything?
Yeah, so actually, very timely. So if you're looking at slide 15, we have a business in blue towards the bottom called ENW. That's our utility business, electric utility in the UK. I'll have to look at my phone when we get out of the meeting. We're day to day on closing our full exit of that business. Again, increasing regulatory risk in the UK. But that's a business we've owned since '07. It's almost 3 times money and 12% return for the time we've owned it, but increasing regulatory risk in the UK. So usually when we sell something, it's because the risk profile is going up. And so that's a case in point. So we will sell if the risk profile changes or the fit doesn't make sense within the portfolio. So usually around the edges.
Okay. And then if you, with that transaction, you've got an influx of cash, what happens with those assets?
By virtue of the fact, and touch wood, that the cash is coming in the next couple of days, before the UK election. But we will, so we have a policy not to hold cash at the fund, so everything we get back from the companies, we send out. So I would imagine that the distribution this quarter will be a little bit bigger than average as a result of that. But generally speaking, everything we get back from the companies goes back to clients.
And if there's a reinvestment directive, then what happens?
Sure, so important point. So we have lots of smart CEOs in the portfolio that have lots of good avenues to grow their businesses. They don't get a blank check. So they have to come back to our investment committee to make the case that there's good risk return on that investment. Their incentive plans are structured to make sure they're focusing on risk as we see it in return. But they have to go for our approval to get that cash.
Hey, James, was your question about reinvestment of the dividend? So you as an investor might choose to not take your dividend and ask
Yes.
JP Morgan to reinvest that within the fund?
Yes.
Yeah, so that's another level. So when you invest in our fund, you get a choice. You can take cash every quarter, we distribute every quarter, or you can automatically reinvest it into the fund,
So what do you do with that cash? So the concept there is you've got this cash that your investors don't want to take it, they want to keep their allocation infrastructure. What do you do with all this cash flow if you've got, 5%?
Yeah, so
return each year?
if you have a $10 dividend that's payable today, you decide to reinvest it, it automatically accretes to your NAV, the cash stays in the fund, and we're using those proceeds to buy new assets and to grow.
Who gets the benefit of the depreciation from these assets tax-wise?
So ultimately, the companies. So we are.
Because we don't need that.
Right. So the companies are owned through, ultimately the way the income is characterized as we pay it out is in the form of dividends. So there's holding companies at the fund level that are owning the businesses. Ultimately, we are obviously putting tax strategies in place for those individual companies. Generally speaking, we are not selling a whole lot. So there tends not to be a lot of capital gains tax, but again, the benefits of depreciation or tax losses are again used at the corporate level.
So is that above our line?
That's above the
So
investor line.
we're benefiting from that then?
So so I think that there's a very small sliver of, so we have a global client base. There may be some benefit for U.S. investors.
Well, I don't
looking
mean
through these
directly, but
assets.
I mean, the corporate, are we getting the net, is what we're getting after taxes, after tax benefits, the bottom line distribution? Or is this somehow sliced up where some entities are getting the benefit of the depreciation of these assets and we're not?
Leased equipment to another company.
Well, this stuff, wind towers or phone towers, they have a life and you depreciate them, and that's why private guys like me buy things like that, because they have a bunch of depreciation.
Yes, so what you'll see within our yield is a combination of yield and total return. So again, for a depreciating asset, like to your point on a wind tower, again, the income coming back for tax purposes and generally, because it is a depreciating asset, is a mix of return of capital and ordinary income. So again, that income being paid out of the fund level, at the end of the day, does have a mix of return of capital from as the assets depreciate and general income.
So I don't know if I'm understanding all of this right, but you invest in companies.
Yes.
Let's say that company buys a wind farm.
Yes.
That wind farm depreciates over time.
Yes.
That wind farm pays taxes because it's a company that makes money.
Yes.
So that depreciation of the wind farm lowers the taxes that they have to pay,
Yes.
right? And that benefits us, the investor, because we owe something that's paying less in taxes, therefore it has a higher net income. And that net income is then distributed to us, which averages about 5% a year.
Yes.
If the depreciation lowers the taxes paid, which increases the dividend,
Yes.
which we then get.
So that's the way it works.
What's that?
That was my question.
That's right. So
Yeah,
what's
that
different,
is the way it works.
conceptually, what's a little bit different, and correct me where I'm wrong on this, is that you're buying companies which own property,
Yes.
as opposed to you buying just the property,
Yes.
right?
Yes. So, and just in terms of thinking about the levels, if you're investing in the fund, you're investing in IIF. IIF is through its entities owning these companies. So ultimately, yes, taxes are handled at the company level, and the income and earnings is
So
coming.
it's not the typical, or not kind of.
So it's not the same as if you're buying a
The
wind
general
farm
partner is
yourself,
one,
necessarily.
and we're the limiteds, and the general partner takes all the tax
Oh, no.
write-offs, or
No.
you can shift it around, so.
No, not at all.
All right, hey,
Sure.
we benefit.
Yes. So maybe, and conscious of your time overall, maybe it's good to spend a minute on performance, unless there's other questions. So slide 21 has the returns of the fund. So general expectation, we value the assets every quarter with independent oversight from Deloitte, KPMG, et cetera. So we are having independent review of all the assets valuations each quarter to strike an NAV, net asset value. We expect, based on we value all of the companies on a discounted cash flow basis. And based on that, we expect all the assets in the portfolio to generate a 10.2 gross return for the next 12 months. If you look at what we've been yielding, so over the past 12 months, we've done better than that, so 10.6. Importantly, the cash yield of the fund, 8.1, 7.7 over 3, 7.1 over 5, and a high percentage of that overall income is from the ordinary income and earnings out of the companies. So again, it's been a very yield stable business with very low volatility, which is on the right-hand side over 5 years relative to other asset classes. And really the highest source of volatility in the strategy over time has actually been US dollar, owning assets in Europe and the UK and Australia. So if the US dollar is strong, there's some depreciation, which you've seen. We offer currency hedging as a service to clients that want it. So we have the ability to invest in a currency hedge share class, which is hedging those exposures over time and reducing currency generated volatility. So overall, promise of infrastructure is high cash yields, non-correlation, and I think this strategy's been a popular one based on the overall performance. So
let me ask you about that cash hedging, because your fund we invest in pays US dollars,
yes.
right? But you own a company, I think you said, is Ventient the UK one?
Yeah.
UK and Europe.
So Ventient, you value that and you say it's worth £1 billion, right?
Right.
Or whatever it is, and then you will then go into some sort of derivative currency hedging procedure where you convert the $1 billion to US dollars, even though you haven't made a transaction, right?
Yeah. Well, so from the currency hedging
Yeah.
vehicle, so if you invest in the fund today, we have 17%. So if you invest 10 million, there's 1.7 million that's end of the day in pound exposure. There's 43% that's euro. There's a little bit of Australian. So what the hedging program does is say you have 1.7 million US dollars worth of pound, and we're going to buy a 3-month forward on that 1.7. And obviously, so we're going to do a hedge between the US dollar and the pound, the US dollar and the euro, and in doing that, we're going to reduce the overall volatility in case there are movements between those currencies. So essentially what it's doing is creating a hedge on the volatility of your exposure over time.
So if you think of it in a nutshell, it's more or less if the currency moves and it affects you, our investment will protect from that to a certain extent. It won't completely flatten it out, but at the same time, it's better than not having any protection at all. So that's what we offer.
What's the cost of that?
Sure, so we offer it on basically a cost plus basis. There's no extra fee to do it. So it's about 7 or 8 basis points of annual cost to run it. And then the hedges themselves can go up or down and create a performance. So the interesting thing is really the hedges perform based on interest rate differentials, and it's very advantageous for the US now. So it's actually added 100 basis points of return from the hedges from a US perspective. Flip side is true for the euro, but right now it's actually been a net benefit for US dollar investors.
So that's page 22, kind of shows
Yes.
that in a simplified version.
Exactly.
And so the magic is going from 5.2 and adding 6.2 or whatever that is,
Correct.
and it becomes 11.2.
Yes. So,
I guess that's what the magic is.
So as you know, we're meeting with another firm, and their performance has been better, frankly. And so what have they been doing differently, and do you think they have a different type of risk in the portfolio that's been rewarded and driven the higher return? How do we put your performance in context to theirs?
yeah, so, look, our portfolio and theirs is quite different in terms of overall exposure. We're much more focused on utilities and contracted power, whereas competitors are a little bit more on transportation and toll roads, without casting stones. I think overall, the returns in our fund are really generated out of cash flow. And if you look at the predictability of our income based on the revenues, where revenues come from, and I didn't spend time on it on the slide. Probably the slide I'm most proud of in the deck is slide 16, not to extend too much. So we think the best kind of revenues are the sticky kind of revenues, and those revenues come from contracts and regulation. The defensibility of our yield is demonstrated on slide 16. Most of the revenue that comes from this portfolio is from contracts and regulation, and even if you do a runoff scenario over the next 10 years, you still have a very high percentage of the earnings of this fund coming from contracts and regulation. So I do think that, in comparing the two, we have a very defensible, analyzable cash yield with good predictability going forward. And also, you'll note that we have not done a lot of selling of assets. So if you sell a good asset, it's no longer contributing to your yield. So overall, I think that the assets in our portfolio are quite stable and contributing to this overall exposure. And we're trying to keep it very well focused on these markets. So very OECD focused, very focused on less volatile areas of the infrastructure market being in utilities and contracted power.
Yeah, we also, sorry, go ahead.
Yeah, I was gonna just rifle off a few quick questions here. What's the minimum investment in the fund?
Is 10 million.
10 million? And then I think we have the fee information. You recently reduced your fee.
Yes, we're in the process of lowering fees that, we're going out for all investors to vote, which are due in February, but we expect the new fees, lower fees to go in Jan 1.
Okay. And the Q, we mentioned that you think investments will be called over 6 to 12 months.
Exactly.
And then, do you have other California public investors?
Yes. I can't name names, but we had a big one come in this year.
That's all public information that was.
It is in the public domain, yeah.
But
Yeah, I know it. Can I say it?
Yeah.
I mean, CalPERS.
Okay.
They're going into this fund.
It's public information.
Yeah, this is public, they're all public entities, right?
Let's get CalSTRS in it.
We also have another plan that we're working with. They haven't completely committed just yet, but we're working with a couple other public plans as well.
Do you have any counties?
No.
I'm not sure.
No, I don't think I do.
And then the queue size, we had a 4 billion in the queue. Is that still correct, or is it changed?
That's about right. So the big thing is that we're in the process of buying a large electric utility in Texas right now. We expect, so it's a public to private El Paso Electric. We announced it 8 months ago. It's about a 12-year process to get all the shareholder approvals and regulatory approvals. So that's about a $2 billion equity check that we expect to be completed in the first half of next year. So actually a very big chunk of that capital is expected to be going out in the next 6 months.
Thank you.
Do we write you a check, or do you call us? Do you call us when you're ready for the funds?
Well, yeah. So if we're so lucky to partner with you, obviously there's a subscription process, and you would enter our queuing system. So if you were to commit in December or January, we'd be in that. When we draw capital, we draw the whole month at a time. So if you're in the part of the December tranche or the January, obviously we go in order. When we need the capital, we draw it, and we will send you a notice with, at least a couple weeks' notice saying that we're going to draw your whole commitment. Importantly, we don't charge a fee on that capital, like a private equity fund, while you're waiting. So you only have a fee once you have an NAV, a net asset value in the fund. So again, you avoid some of that paying while you don't have anything. And then once you're in, you're earning the yield of the portfolio. So you avoid the J-curve risk of private equity.
Any other questions?
Great. Well, I greatly appreciate the interest and enjoyed the discussion. Hopefully it was informative, and certainly we would be delighted to partner with you as
Absolutely.
launch the allocation.
And, just a few last notes, we spoke briefly about our competitors, but there's some things that you have to remember. We're focused on OECD countries, well-developed countries. We do not get into emerging market exposure. We feel as if, where we are currently are developed countries that it's clear to see what their macroeconomic environment is. So there's less uncertainty in the portfolio, so we try to stick that way. We stay away from trophy assets, just large assets, because essentially we believe that by forming contracts with local players, for example, we're able to take much greater ownership, and with ownership we're able to develop which direction these businesses can go, and that's super important. So we won't have a situation where, for example, a CEO is being paid X while they're not doing their job. We can step in and say, hey, listen, this isn't working well, and we need to make changes. So we're more impactful than other funds that are out there. But as my colleague said, we really thank you for your time and thank you for your consideration, and we look forward to hopefully partnering with you at some point.
Can I ask one question? Is in your retail assets that you've acquired for utilities, have you had any social justice issues arise on the ground?
Not necessarily social justice. I think one of the things to maybe part with, if you read the public statement, so when the board approved our offer for El Paso Electric in Texas, if you read the press release, it's really focused on local community. So we promised to own the business for 10 years. We promised to keep the management team there, not manage it from somewhere else in the country or the world, and also to work with the local community on affordability issues. Again, we spend a lot of time on social contract. So ultimately, the challenge we put to our companies is to turn the regulatory conversation around. Usually, when you call the regulator, usually they're expecting there to be a major problem. We're trying to call the regulator and talk to them about constructive solutions in communities. And it's it's trying to change that conversation. But so to your point, not really social justice implications necessarily, but we are trying to work cooperatively with local regulators, customer groups, et cetera, in terms of our impact on communities.
Thank you very much.
And we're also, sorry to kind of beat a dead horse, but we're also very ESG focused, not only as a firm, but even in the fund itself, across the investment spectrum, we care about social issues. We're more keyed in on the governance piece than anything else. In terms of minorities and diversity and inclusion, I think many years ago there were 9% women on the team. Now we're up to 40%. Not to say that we've completely fixed the issue, but we're going in that direction and we're moving, head on really fast to get things in terms of having things equal across the board. So just want to leave you with that. If there's anything else, please reach out.
So I wanted to give both of you an opportunity to address two of the things that I was concerned with on slide 15. Ventient, which it holds the highest percentage of investment in your entire portfolio, it looks like just underwent expected refinancing in Q4, and that's gonna go down to 10, so that's concerning to me. I thought that you might be able to offer an explanation, and it's a compound question. ENW is one of your longest investments from 2007, from when you started your fund, that you are selling out. So are these indicative of changes that your company's making, or problems?
No, so I think both are good news items. So Ventient, I think both relate to diversifying away from pure UK exposure. So Ventient, we did a two-part acquisition this year, where we bought assets in France, Germany, Spain, Belgium, forgetting one. But we've doubled the overall size of the business through actually 4 acquisitions that we did this year. And for efficiency of buying those businesses, we equity financed them. So that was a competitive, speed to be able to due diligence and close was part of the advantage. So Ventient, we bought and doubled the business without using any debt. So the refinancing was actually a very accretive outcome to underwrite, because we did a global refinancing of the whole business as we integrated the European assets into the UK. And it's accretive to overall return. It's going to be a return of capital in the distribution probably this quarter. And overall, it's investment grade capitalization. It's interesting. Very good participation. It's one of the largest wind financings that there's been, certainly this year and in recent years. So that was a very good outcome for the fund. And again, brings the overall Ventient exposure way down from 18.8, which was a point in time before we had taken the extra equity out. ENW, again, very good investment for a long time, but as mentioned earlier, regulatory risk is going up in the UK, and that's a good time to, we don't usually sell assets wholesale, but it was a good time to, take chips off the table where we thought risk was going up.
Thank you.
Sure.
Thank you.
Thanks again.
Hey, thanks so much for your time.
You want to take a 5-minute break?
Yes.
Okay, great.
Calling the meeting back to order.
$5 million.
Okay, all righty.
Thank you, Madam Chair. We now have IFM. Gentlemen, I want you to introduce yourself to the board and take it away.
Sure. Well, first of all, thank you all very much for taking time to meet with us today. It's a great opportunity to come up here. My name is David Eltschuler. I am the head of North America for the Global Relationship Group, which is our business development group, our investor relations, and our product specialist team, which is responsible for communicating about our investment strategies with our investors and consultants. I joined IFM about 2.5 years ago, and prior to that, I worked very closely with organizations like yourselves, specifically out here in California. I was an investment consultant focused on infrastructure with, first with Makita Investment Group, and then with Stepstone. So working with not only the 2 largest pension funds in the state and the country on developing their infrastructure programs, but also with many county and local funds as well. So it's to me, it's really great to be able to come out here and meet with you all and share our views on not only the asset class, but also IFM. IFM also has worked very closely with California investors, both with the 2 largest pension funds, again, in the state and country, through our fund and through direct investments. We also have 3 California county retirement systems as investors in this fund that we're going to speak about today, in addition to many other institutions that are based here. So I will pause and let Chris introduce himself.
Thanks for having us today. I'm Chris Ray. I'm an associate on the Global Relationship Group based out of New York, and I've been at IFM for about 4.5 years. I primarily focus on business development for our infrastructure platform. So that includes infrastructure equity and infrastructure debt. And prior to IFM, I was in investment banking for a boutique bank in New York City.
So you all have a presentation that we provided. This is your meeting. We're going to try to follow the presentation, but I've heard that you're going to do this anyway, so I don't need to invite you, but jump on in, make the best use of the time here. But what we had planned was to walk through a little bit about the infrastructure sector, which again, I was warning Jan, I'll be putting on my consultant hat a lot, just because I used to have to do this quite a bit with folks like yourself about how to look at infrastructure vis-a-vis other asset classes and strategies, how to look at the infrastructure space, which is really distinguished by a number of risk-return points in the spectrum, and where IFM sits in that and what our focus is. Then we will turn over to IFM and talk more about our strategy. So does everyone have the presentation open? So if you turn to slide 5, as I said, I wanted to just give a higher level overview. I'm sure you've heard some of this already from your consultant and probably from other managers, but infrastructure has been historically something of an odd duck when you look at it from an asset allocation standpoint, because while it is, and what we're talking about today is unlisted infrastructure, so in many ways it does have similarities to other private market investments like private equity, like real estate. It's also very different from those asset classes, and it provides also very different characteristics from listed equities and from fixed income. So on that slide, we just outline kind of high-level building blocks of asset classes, and like private equity, our fund and other unlisted infrastructure managers invest directly in companies. So we own the companies. Sometimes those companies are already private, and so it's private to private. Sometimes they are owned by the government, a public entity. We have one of those in our portfolio. We have a few of them we'll talk about. So it's taking that asset, and sometimes it's not even ownership. It's just a concession to operate the asset from the public sector saying, here, private sector, you run this for us. You run it according to these terms and conditions, and we'll pay you accordingly, or the users will pay you accordingly. And the third is a take private, which we can do as well. So we can go from private to private, government to private, or even public to private. Private equity does a lot of that, typically less so the government side. The real difference between private equity, and we'll come also to our strategy in particular, is really the nature of the investment strategy, the objectives, which typically involve more risk to generate a higher return. Our strategy and infrastructure in general, as you look at it from an asset allocation standpoint, should be defensive. It should be that asset class that is not going to be taking a lot of risk. You're not going to be looking for those outsized private equity returns. You're not going to be looking for a lot of leverage in the transaction structure to be able to help increase those returns. And also, for us in particular, it's not the case with all infrastructure, but for us, and you'll hear about that, we are very long-term investors. So we're not looking to say, let's buy a company and then sell it in 5 years. Big difference between private equity. In addition to the types of assets, which goes again to the risk profile. These are supposed to be the kind of sleepy assets that no one even pays attention to. Like when we flip on the light switch, we just expect the lights to go on. We get in our cars and drive, we expect the road to be there and operational. It's not discretionary business where you go in and say, okay, well, there's Best Buy there today. Some other company may come in tomorrow, Amazon, and take their market share. It shouldn't work like that with infrastructure. It's a big, diverse asset class. We can talk about that, but that's really the big differentiator from private equity. From a return standpoint, maybe the last thing I would comment on this slide is that you should see a significant portion of the return coming to you as an investor from operating cash yield. From the businesses, they should have healthy margins, they should be able to continue to generate cash flow, and that cash flow does come back to investors, and that will be different than a more growth-oriented private equity strategy, for example, where they're taking that capital coming in and using it just to continue to grow. A lot of questions about the relationship between infrastructure and real estate. In many pension plans, they sit together. They sit together, for example, at CalPERS, the largest one here. They do have similar characteristics in that real estate originally did, as an asset class, come to play that role of a diversifier from equities, a more defensive strategy, and a strategy that had more of a connection to inflation as the leases continue, that generate real estate income could continue to go up. Real estate and infrastructure, even though infrastructure often involves a real estate component in that assets sit on land, it's typically not the land itself that is the source of the value, it's the business that's operating on that land. So when you look at a toll road, for example, obviously, which takes up a lot of space, but it's not the underlying real estate that's the value, it's the fact that it is the only way to get from point to point, and it's the ability to charge those users for that. There's a lot of other distinctions between real estate that do impact the way that the returns look like to investors, including the fact that we are looking to target monopolistic assets. So, meaning if there's an airport, like we own an airport in Manchester, England, or the Indiana Toll Road here in the US, it's very difficult to just build a competing route. It's very difficult just to put up another airport. It involves a lot of regulation, it involves the whole government approval process, and then there's this whole question, oftentimes those airports are zoned for particular, or the land is zoned for particular purposes. Class A real estate, there's room, typically you can just build another building and build another, and we see that all the time with shopping malls, housing. Real estate can be a fantastic investment, it just has very different characteristics. Shorter term leases, from a valuation standpoint, they tend to be more like for like. You can look and say, okay, this Class A real estate in New York, Class A real estate in San Francisco, you can do some comparisons, figure out. It's a little different with infrastructure because how do you compare two toll roads? How do you compare airports in different cities, different markets, sizes, routes? They are very specialized assets. And that also goes to generating that return, which is that you're running a business. You're not outsourcing the management, upkeep and so forth of an office space to a real estate operator. We're working in our role with the board and with the management team on running businesses. So it is very different from not only where the returns come from, but where the value is, and what we look at is that really defensive, protected position that the assets have. Moving down when it comes to listed investments, again, private market investments in general, that goes for private real estate, private equity, infrastructure, should be more stable in terms of the returns. Part of that is because they are not mark to market daily. The other is that the nature of the businesses when they're not in the public sector can, particularly with infrastructure, be managed to take a long-term view. So we're not constantly having, shouldn't be having to go to shareholders and with quarterly earnings reports and so forth, and all of the filing obligations, reporting, and ultimately business decision making that happens with the listed market. The market doesn't also, it also doesn't move together like you see with listed. The stocks trade up and down, irrespective sometimes of the underlying fundamentals of the stock. They kind of trade. Infrastructure in particular should be much more stable, much more predictable, not only because of the fact that it is not having to trade against the market, but it also is providing and should be providing essential service to people like all of us. And so, yeah, people drive on roads maybe a little less when they're not commuting because unemployment is up and so forth. Reduce traffic, reduce commercial trade, but at the end of the day, if you have the right asset in the right market, and it has that essentiality, which is something that's critical to us, it should be relatively, tick along. So it is a real diversifier, and you see this, you look long-term. We didn't provide a lot of these statistics here. I'm sure you've seen them before. I would caution a lot of the data that gets used to characterize infrastructure, like on the efficient frontiers and all the various comparisons. There isn't a really good, robust data set for infrastructure as an asset class over time. People ask all the time. I used to have to talk about it all the time. What is the benchmark? How do we benchmark this? What do we look for? It's a challenge for some of the reasons I talked about. There isn't an easy way to compare like for like with different assets. It is still a relatively new asset class. We don't have that long-term history to go back and say over time this is how the asset class has performed. But when you look at it and we look at it in the examples we see, and now there's, I think, a growing data set of investments, you really do see through the global financial crisis and after very differentiated returns compared to listed markets. Less of a dip. Certainly there was a downtrend, but it also didn't go down as much. It didn't have to go up as much either, which worked out very well. Fixed income, interestingly, some investors do put infrastructure into their fixed income buckets. This is less of a trend now, but the characteristics that investors were drawn to for fixed income was really the cash yield. And as interest rates have been at such low levels globally, the ability to generate any kind of cash yield from an investment is considered to be positive from a fixed income portfolio. There is a wall of capital now in the market that has been created by the shift from fixed income to alternatives, including infrastructure in particular, because of this cash yield profile that I talked about. We caution investors towards thinking or overthinking the analogy or parallels between infrastructure and fixed income, because it is not a bond. These assets are complex, operational, live parts of our world. There's no fixed guarantee to get anything. I'm sorry if anyone's ever telling you that you can get guarantees from things like this. I would just caution you to think twice about that. They do have a cash yield. They can be predictable depending on the asset, similar to fixed income, but you're not taking on a bond-like risk, and for that you should be expecting ultimately a higher return. And so just being honest there in terms of the way that sometimes we see infrastructure get characterized as, it's almost like a fixed income substitute. You can just clip a coupon when you get your cash, and no, somebody's got to be able to run that business. That business needs to continue to be upgraded, needs to continue to be expanded, needs to continue to meet the regulatory and other requirements. So it is for us, even though we do have a core strategy, we always like to remind investors that it's a lot of work to generate the returns that we do, and that would be very different from a bond. Any questions before I turn over more to the infrastructure market in particular?
I think page 7 is interesting about your investment focus.
Yep. Okay. I'll just touch briefly just on 6 and then turn to 7. 6 has just this spectrum because I have been speaking broad brush about infrastructure, it being a single type of strategy, single set of characteristics. It really isn't. There are a number of very credible ways to access the asset class, from a much lower return, lower risk, to a higher return and higher risk. And it really does straddle the two. So this slide here, we just wanted to position not only the types of underlying strategies that an infrastructure manager can invest in. We, IFM, are more on that core side, just on the left, lower risk, and what we think is an attractive risk-adjusted return. There are many more very compelling, very good, closed-ended, more private equity-like infrastructure managers where they're taking on more development risk, more business risk, operating in a shorter time frame to deliver that kind of private equity-like return stream with, on a relative basis, less risk maybe than private equity because of the sectors they're investing in. Just wanted to understand it is a spectrum, and where IFM sits. If you then turn to slide 7, this is how IFM talks about what we do, how we look at infrastructure, and those top 7 points really are the characteristics that we expect to be delivering to you on our portfolio. I will be clear, every asset does not always check every one of these boxes in exactly the same way, but we are looking to deliver an overall portfolio, return and risk and characteristics that have the following characteristics. As I talked about, monopolistic. These should be very difficult to replace, very difficult to compete against. And whether they're in the transportation sector, energy, utilities, we always look to identify and have to, what are those barriers to entry? For us, infrastructure should be a long-lived investment. We look for long-term returns. Infrastructure should be able to deliver that. And then they're long-term through the assets themselves, which have 30 plus years, typically, of life. They also have concessions that give us the right and opportunity to continue to collect a revenue from that asset. So when we acquired Indiana Toll Road, that had over 60 years of concession left on it. So long life, that's what we like to see in infrastructure, not interested in short term. Stable and predictable revenues. These revenues come from a number of sources. The stability, it can come from a government regulation. It can come from a contract with an off-taker, a utility, or it can come from the fact that these assets, even if they are exposed to market, are core essential. Even if trade dips, there's still going to be the port that shippers are going to go to. There's still going to be the road that the freight's going to be carried onto. It can move a little up and down with GDP, but it does provide a very stable and predictable revenue stream. Inflation protection is interesting with infrastructure. It's often embedded in these concessions and operating agreements we have that we as a manager are able to increase the tolls, the charges to the users, whether it be an airline at an airport or a freight truck on a toll road, by inflation. It's one of the characteristics. So it's not even in low inflation environments, there's still possibility for contractually for an infrastructure manager to effectively index inflation. We think infrastructure should have some exposure to economic growth. So when we look to identify assets to invest in, we want to see that stability. We want to see, and we look and we underwrite our investments to what that base case is. So this is the here and now. We also don't include an exit when we underwrite. So our returns have to come from what we've identified as tangible to deliver. We do like to see the ability to benefit from the upside. When the economy is doing well, we should be able to benefit from that without having to give up on the downside. So we do expect to see that exposure to economic growth. Economic growth is a fundamental characteristic of society, fundamental characteristic of infrastructure. Really important with us, we want to find assets that are quality assets and that we can use in the financing part of it, so the debt part of that, investment grade, high quality, low cost debt. It's a big difference for us than from some other managers. These assets have to be good enough to get strong credit packages, including primarily investment grade. What that does for us is it provides a lot of stability in the financing, and it also is a lower cost. Because investment grade debt is lower. So it's and we'll get into how IFM thinks about debt further along. When we invest in assets that do have exposure to regulation, we will only do so in markets where there is, and that's market geography, but also market by sector, where there is transparent, long history of stable regulation. We are in an environment now, and you're going to hear a little bit more about that too, where there's some generalizations being made. All regulated assets are good assets. All regulators are, independent and free from conflicts and are able to manage what are a number of challenges going on from not only an economic and social standpoint, but as you all saw here in California with PG&E, from an environmental standpoint. So if you're an investor and you're saying, okay, I'm going to take a lower return because it's such a high quality asset because of this regulation, it sits in this regulated, just fantastic state like California, real strong history of utilities operating here, and then you see what happens. And so the challenge is for a regulated business, unlike one of those discretionary, the Best Buys or whatever, there's not a lot of levers to pull to make up for these setbacks, bankruptcies, et cetera. There's not new market share you can pull into. There's not a lot of consolidation. You can't use a lot of the same strategies you would use in a private equity strategy. So you're stuck. And it's not just California. It's everywhere that there's increasing pressure on regulators, and it has really informed what we do. If you go to the second part of that slide there, you see three areas that IFM has historically focused on. They are transportation, utilities, and energy. Transportation for us, as you see, are toll roads, airports, and seaports. We own a lot of them. We own a lot of them globally. It's a very diverse portfolio of transport. We like transport because of what I said before. The assets we own are very difficult to replace or compete with, and they benefit from upturns in the cycle. Utilities. IFM has historically owned many utilities. We still do. In this period of time, we have been a net seller of utilities, and we have done so for two reasons. One is that the prices that investors are willing to pay for some of the reasons that I explained earlier about they look like bonds, they look like they're gold standard. There's a lot of investors that are willing to pay a premium for utility. We have taken the view that we like a lot of utilities, that we have a 10% net return target that we have to manage to. And you'll see how we manage to it, and it's really important to focus on that, because we do. And the prices that we would have to pay to compete for utilities now make it difficult for us to deliver on our return target. So that's the return part. And then there's the risk part, which I just talked about, which is the fact that we do see there is increased regulatory risk in these assets. And regulatory risk, unlike other risks, becomes kind of binary, because the regulator and the framework that they set up for us to invest in, if it changes, so does the business case. And we have no recourse. I mean, we can go to the courts and so forth, but at the end of the day, you're stuck with a kind of a binary outcome. That for us is a challenge. So for us to really look at utilities, we need to be able to see that there's an angle for IFM in that to manage what it is, the risks apparent in that asset, as well as to deliver on the return. And you'll hear also we do it with very, very conservative leverage. So it's the other thing. If you've got a big regulated utility, they typically have a very large rate base of the payers, like all of us. That allows them to put a lot of debt on investment because it does have a large payer base, diverse, stable, et cetera. That for us creates another risk that our fund is not focused on taking on. The last part of that of our area that we focus on is energy, which is really energy midstream. And this is an area where we've been incredibly successful. It is a core part of our portfolio. And it's one where we found this complementary balance between having regulated exposure, contracts with high quality counterparties, that pay us whether they use the asset or not. They're called take or pay contracts. We can talk about that in our portfolio. And also where they are providing an essential service. The flow of fuel across the country and the globe is an essential service that's provided. So for us, it does check a lot of boxes, and we do see opportunity. So that's what we were going to talk about with infrastructure, kind of the higher level. Before we turn to IFM, is there any questions about anything I said, or? Yep.
How do you allocate the income stream to return on and return of investment?
Allocate in terms of
Well, how do we get our money back?
Yep.
So we buy a road that's got a 60-year contract, and then at the end of our 30-year investment, now it's only got a 30-year life left.
Yep.
So, and the next person that buys it,
Yep.
at the end of the road, how do you get your investment back and the appreciation or depreciation or loss that goes with it?
Yep. So there's three pieces, legs of the stool there. One is the unrealized value. So our assets are valued like any other asset, any portfolio. Ours are valued quarterly. They're valued independently. Each asset independent each quarter. That contributes to the growth in that unrealized value that will not be returned to you. So that's one. But that shows the growth of the value of the investment. So were we to go sell it, that would be value. The second is when we do that, and we have done that. So we will and have sold assets. Even though we are a long-term strategy and our goal is to own assets for the long term, we have sold fully and partially assets in the portfolio, and they're in this presentation for two reasons. One is portfolio diversification. So we acquire a lot of unique opportunity for IFM to acquire a stake in Indiana, or we acquired all of Indiana Toll Road. At the time, that asset represented a significant part of the portfolio. It was the largest transaction in the fund at that time, and it was just above our fund concentration limits. So we sold approximately 15% of that asset down to external parties. That generated a realized return. That was actually at a significant premium. Within 12 months of us acquiring that asset, we sold down a portion of it. To manage, the goal was to manage portfolio diversification. That came back to our investors as a distribution, cash distribution. Those types of, and we've had those before. We have also sold outright assets. So that, we owned a German electric utility transmission business that was kind of a sleepy business in a relatively sleepy market. That was a real gem for a strategic in the industry from China, looking to a very different business model, very different cost of capital, other factors. And they came with a very significant premium above what we, as owners and operators of that asset, hoping for the long term, we loved it, could ever envision generating as a return. So what did we do? It was a little more complex of a process, and ultimately there was a preempt and so forth, and at the end of the day, it sold in the same terms. That went back to investors as a cash distribution.
I'm thinking more simple terms of you buy a windmill.
Yep.
Well, at the end of X number of years, the windmill's worthless.
Yep.
So how do you recover,
Yeah,
how do you
it's-
value that?
Yeah,
So
excellent point.
You
So-
gotta get your investment back over the term in addition to the return on that investment, so when you get to zero, you got all your money back.
Yep.
So how do we?
So
how
excellent
does that
point.
work?
We, for that reason, do not invest in standalone generation assets for exactly what you said. It doesn't fit our structure because we have to own assets for the long term. For a standalone wind farm like that with a 15-year offtake agreement, a PPA, that asset will depreciate, the value will go down, the contract will run out, and at that point, we're not left with anything. And in some cases now, because it's such a competitive market, we may not have even made our invested capital back. So we will have to go into the merchant market and sell that power, taking on what could be technology risk, because now we've moved on and on and on, and go to the market and try to sell power because we no longer have that contract, or try to recontract with that utility who now doesn't necessarily need us like they needed us 15 years ago. So that's not really part of the IFM strategy. We look for assets that we can continue to own and grow. Again, we know that airport is going to be there. The airport's not going to depreciate and wind down and go. We are very involved in very large scale capital expenditure projects. We do these all the time to continue to grow the value of the asset. So there shouldn't be a situation in our strategy where we're left with a stranded asset. And we always do look to understand at what point, and it has to be in a reasonable time frame for us, we get our money back. And that means you get your money back. The rest is the upside that we look to get through our active management and continued growth. And then through these opportunistic exits, and it is different than other open-ended funds in that we will sell. Anything else before we turn on to IFM? And tell me if I'm taking too much time, or you tell me if this is okay. So I want to just give a little bit of background on us, slide 9. Because what I can say with conviction is that you've never met an organization like us. I'll just put that out there. Having done this for a long time, I don't think you'll argue on this point, you can argue on others. IFM is 100% owned by pension funds. We were set up over 25 years ago by a group of Australian pension funds called superannuation funds. I will spare you the whole history of the Australian retirement savings market and changes. Cutting to the chase here, there was a change in the industry in Australia that led to the creation of what are called superannuation retirement funds. And what's really important is that employees, I think all of them, the majority, were required to make mandatory contributions into their retirement. And where that is today is over 12%. So if you work in Australia, 12% of your income will go to retirement. And it goes to these retirement funds that were originally set up by industry. So if you look on the left side, these are the ones that own IFM, and have owned IFM since the beginning. They are industry funds, there's construction, hospitality, et cetera. Now in the market as an employee, and I'm not an expert on this, but you can basically go and invest with any of them. And they're now, the fastest growing retirement system in the world. And what they knew then in the 90s was a couple things. One is that with this mandatory contribution policy, they are going to grow. They're taking in capital required contributions, population growth, do the math, growth. The second is they knew that the Australian market that was investable was going to not grow as fast. They can't have all of the retirement savings invested in Australia. So this group came together to create its own manager. And that manager was called Industry Funds Management, or Industry Funds, and now it's called IFM. The purpose was to provide this group initially, and then other like-minded investors, who, being very direct here, are people just like you and your members and the retirees, with two things. The scale benefits. So you're sitting here in Mendocino County and they're sitting in Melbourne, Australia, and everyone benefits by having this more and more people coming into this collective, because the more they're investors, the more we can invest in the team, the more we can build the global capability, et cetera, et cetera. That was the only way they could effectively compete with the institutional managers and also invest globally, which was the scale, recognizing it can't just be Australia. The second part of that scale benefit, and you'll hear about that too, is the fees. They are incredibly fee conscious. They are people like you. They need to generate a net return. And IFM's purpose is to deliver superior net returns to investors. That means that the people, our shareholders, and it's 100%, no one else owns IFM except those pension funds. They are focused on fees and they review our fees. They're required to do it. And what that has resulted in is not only lower fees to begin with, but we have had since the launch of this product in 2004, the fees, if I'm correct, have come down 40% to investors. So as the scale increases, it allows us to continue to invest in the business, which is a top quartile infrastructure manager, competing for talent, competing for assets like anybody else. But because of the ownership structure, we are able to take that dividend that IFM generates as a business, and we don't have a bank to pay. We don't have stock shareholder, other thing, it's just us. So they are making the decisions again. How do we continue to pass on the scale benefit? And how do they continue to benefit from it themselves in terms of the lower fees? So what you see is what we think is not only a truly aligned ownership structure, legacy, and purpose with people like you, who are over 90% of our investors, and the others are companies like insurance. No high net worth, no retail. We are here for pension fund investment. We think there's an alignment philosophically with people like you and what you're trying to achieve. We also think it's really aligned with infrastructure, which again is this long-term strategy, which is why we came out. I think there may have been others, but no one on our scale has been the really first large open-ended fund to invest in infrastructure. We wanted to be able to be the long-term patient investors like you all, focused on that growth over time, focused on getting a cash return, but also making a difference in the communities that people are living in and the services they use. So it is, and as much time as we have today, you'll hear in our returns, in our investment strategy, in our approach to asset management and responsible investment, this all matters because it all connects to who we are and why we were set up in the first place. And quite frankly, I think fast forward to today, almost 25 years later, it's proven itself out because now we have the scale to be global, and we have, I think, a very compelling performance, top tier team, largest team in the industry, and at what we think at a fee that's fair for investors, because again, that's being determined by investors like yourselves.
We have about 20 minutes.
Yeah, I know.
I just want to make sure we get to talking about the fund.
Yep. So I will. Slide 10 has an overview of what that all means from a scale standpoint. I won't go into it, but it's a large global platform. What I will do is turn it over to Chris, and he can walk through a number of aspects of our performance. You can see it. It's here. We want you to see what it is in the portfolio.
Can I be for?
Yeah.
You mentioned a few times as far as investment strategies for your company.
Yep.
You mentioned obviously focus on a 10% return rate. You also mentioned numerous times the risk assessment of investments. What would you say is the primary and what's the secondary concern when you guys are analyzing a new investment?
Good question. We will not invest in an asset that has a risk profile that is not going to allow us to own it for the long term and be consistent with, we don't have an exit strategy for these assets. So when we go into them, we have to really understand the risks, the market dynamics, regulatory dynamics. So that's one. Two, we manage to a 10% return across the portfolio. We recognize not every investment is going to be exactly at that 10%. So our objective is to give to you a 10% return. And then we look at it and we say this over cycles, it could go to 8%, it could go up to 12%, and it has, and you'll see to the upside. It has gone on the lower end too, but that's the range because it's a long term and there are cycles. It has to be these both, but what the team is really focused on is if we see that return and it's not consistent with the risk profile this fund is going to take in that we can own for the long term, because again, we're not looking to sell it, it won't happen.
Great. So I'll discuss the Global Infrastructure Fund at a high level. I'll talk about returns, the team, the strategy, and then we can talk a little bit about the assets. So turning to slide 12, you can see the snapshot of the fund. It was incepted in 2004. There are now 17 portfolio companies. And so these are platform companies. It doesn't represent individual assets.
And just to be clear, this is September 30, so there was an acquisition, so some of the numbers that Chris is going to reference are not totally going to line up because we made a new investment.
There was one close on November 1st. So 17 portfolio companies across 43 countries, representing now close to $30 billion. So that most recent investment was a $4.5 billion acquisition.
It's a big one.
Yep.
And since 2004, we've delivered consistent returns between the 8 and 12% range that the fund targets. So since inception, it's 9.1%. And in the recent years, we've outperformed tremendously, especially because of one divestment in particular, which we can talk about later in the slides.
And just to be clear, that since inception does include the GFC, so this is inclusive of that and 9.1% return, and this is net of all fees to you.
So these are net returns, and in addition to the total return, there is the cash yield component, so 6.9% cash yield since the fund started making distributions to investors in 2012. So slide 13 shows the client base, and it's very well aligned to the shareholders. Over 90% of the investors are pension funds, and as the fund is based out of Australia, the firm is an Australian firm, but now the majority of the investors are outside of Australia. So 35% of the investors from the US, and we have some of the largest public pension funds in the United States. So 362 investors representing 30 million members and retirees. So we also have one of the largest infrastructure teams in the world. So slide 14 gives a snapshot of that. Kyle Mangini, he is the global head of infrastructure. He's based out of Melbourne. He's been at the firm for over 10 years, and even all of these senior members.
I'm sorry.
It's okay. So Julio Garcia, he's head of North America. He's been at the firm since 2007. Christian Seymour, he's been at the firm for 13 years. And Michael Hanna, he's been at the firm for about 12 years now. So there's a very diverse skill set from the team. So across operations, investment banking, capital markets. Some have spent time working for the government. So some regulation background, structuring public pension private PPPs, as well as project management and commercial construction. So it's really important to have a very deep skill set and a very diverse specialty.
You want, for infrastructure, a strategy that can do as much as possible within the remit, and that in terms of the countries, in terms of the types of opportunities. You want the diversification. This is a benefit. However, you want it only if the team and the firm are set up to actually be competitive in all of those markets. The challenge is if you go into more constrained strategies and that capital has to there's pressure on the manager obviously to deploy the capital even if the market conditions aren't there, the right opportunities aren't there because they've got the expectation to deploy. So in general, you want to be able to cover as much as you can that fits within the strategy in terms of the market with the markets and the sectors, and that you need the capabilities that are going to be able to actually deliver.
So the investment teams are primarily based in New York, London, and Melbourne, Australia. So we have boots on the ground in each region we're investing in. We also have an office in Hong Kong, which monitors investments in Asia. So we don't currently have an Asian investment, but we are monitoring that space. So we also second individuals to portfolio companies, especially when we acquire them. We want to make sure we transition them into the portfolio. And they work on specific projects, whether it's streamlining reports, working on budgets, or construction projects. And that's important to transition the companies in the portfolio.
It's quite frankly why the companies want to work with us, is because we put our people in these companies, and these people, so for example, we not long ago last year acquired port terminals in Vancouver, Canada, and in the New York Harbor that has been run historically out of Vancouver. And quite frankly, they were one of the angles for IFM was the fact that we were actually going to put people on the ground there who had experience working in ports in Europe and Australia. And that's the benefit for them sitting in Vancouver is we're not just going to be sitting up on the board, but we're actively going to be involved working alongside management, working alongside their team, and bringing best practice that we've gained from other assets into the companies themselves. And we had one of the CEOs, not to digress because I know I'm short of time, but we had the CEO of that company come to our annual meeting. And he said that this was one of the surprises was to see the level of engagement from us, and this is how IFM operates.
So the day-to-day staff, 92 professionals specifically focused on infrastructure. The other component is our senior advisors. So we have 24 senior advisors that help us in originating deals, so relationship management, as well as transaction due diligence. And so they're on a retainer specifically for infrastructure for IFM. And they're compensated not to, they're not incentivized to encourage us to purchase an asset. We want them to also tell us reasons why not to invest. So they're very involved in risk management as well as the whole transaction process. So why don't we move on to slide 15, and this gives a layout of our investment strategy. So IFM's philosophy is to build, maintain, and operate infrastructure assets that are monopolistic in developed markets. And we want a portfolio to be resilient to different macroeconomic scenarios. So these assets will primarily be in North America, Western Europe, other OECD countries with strong rule of law and in a predictable regulatory environment. Credit ratings are really important. We want the countries we invest in to be primarily investment grade. And we have a buy and manage strategy. So we want to hold for the long term, but we can also sell assets, and we can talk about some of the examples where we've sold, either partially or fully. So a differentiator is that we use very conservative levels of leverage. Now, if you looked at some peer infrastructure managers, especially within core, you could see leverage up to 60, 70, 80%. And we see that as a big risk, especially towards the late stage of the market cycle. That's part of the reason infrastructure managers got in trouble during the GFC. Assets were too highly levered, and then they went into bankruptcy. So the weighted average leverage of the Global Infrastructure Fund is currently around 30%. And so we have a target to be no more than 60. So we want these companies to be investment grade rated. We want to hold them for the long term, so we would expect to refinance them. And if it is during a downturn, we want to make sure we can refinance and have an advantage during that time.
Which is what we did post-GFC. I mean, it was a real opportunity for IFM to refinance, extend out maturities, and so forth. So we looked at that as an opportunity. But as Chris said, in this market, financing is very available, and we have still kept the level at well below our target for the fund, because we do not want it to be we don't look to it to drive the returns, and clearly the returns are there without that. We don't look at it to pay a cash yield, which is what the more leverage you put in, and you can start using some of that to pay out, and we don't look at it for the risk that it can create in the portfolio by having to be stuck in an environment where we can't refinance, and we don't have a lot of levers to pull to be able to increase the revenues, because these are just, again, these assets doing day-to-day stuff.
So the third point of this is that we have very active management within these portfolio companies. We always take a board seat, so we usually want to sit on important committees such as the Audit Committee, the Compensation Committee. We want to make sure we can structure the management compensation correctly to incentivize them to do certain ESG initiatives, growth initiatives, work with them during M&A transactions for bolt-ons and capital investments. So we want to be able to shape the business plans of these companies. You can only do that by actually having a voice on the board.
Good question. Ownership position in these, or have a board member, do you have 10%, 100% ownership? What does that look like throughout the portfolio?
So it depends, and we always take a board seat so we have enough equity interest to do that. But in many scenarios, we're either a majority holder or have co-control. And there's actually been instances where we have minority control, and then we build up our equity interest in the company to be a majority shareholder.
We don't require either a supermajority or full ownership, because we found time and time again that having the right partner provides strategic advantages to us. So we want to have, if they're the right partners with us, we want to have them at the table because they bring advantages. We partner in our ports with the largest port operator globally. So we're just with them in a couple of assets, but they're, for example, buying cranes for all their ports. We benefit from the scale, we benefit from the insights, we benefit from new opportunities from them as they are looking across globally. So it's an excellent question. We often hear, oh, it's, you need to be the majority or the 100% owner to actually drive influence in the business, and that's just not been our experience.
So the competitive advantages of IFM include the open-end structure. So that helps us with sourcing investments, especially with strategic investors. As David mentioned, Port of Singapore Authority is the largest seaport operator in the world. We've partnered with them on 2 investments because they see us as a long-term partner, helping them to grow businesses. Same with Manchester Airports Group. We partnered with Manchester City Council and then helped them acquire an additional airport for their portfolio, Stansted Airport, as well as Global Container Terminals, which is a container terminal business based out of New York, New Jersey Harbor and the Vancouver Seaport. We've partnered with Ontario Teachers on that deal as well.
Large, sophisticated direct investor pension fund, it was the largest exposure in their portfolio, and they wanted to sell down, and they wanted to bring in another like-minded, long-term investor like us, but also wanted to have other port experience from other markets who could, again, help educate, bring best practice relationships. So that's sort of the angle that we fit from a partnering standpoint.
And we can be very flexible on the equity bite size. So we can do $500 billion transactions as well as over $1.5 billion. And as I mentioned, the most recent transaction was $4.5 billion. So we have the ability to execute complex, large transactions because we have the largest team in the world, global footprint, and we can source these transactions through our existing portfolio, which is close to $30 billion, which could be the largest infrastructure portfolio globally. So slide 16 has some open-ended benefits. I know you're familiar with the open-ended structure, but just to reiterate, there's no J-curve, so there's no fees on undrawn capital. And so you're drawn into an existing portfolio with immediate diversification, immediate cash yield. So that is an advantage of the open-ended structure. Slide 17 has our portfolio evolution. So if you were to look back prior to 2013, you would see the portfolio heavily weighted to regulated utilities in Europe. But coming out of the global financial crisis, we wanted to make sure we got exposure to transportation assets, which had strong economic linkages to GDP. So in 2013, we acquired Manchester Airports Group. In 2014, we acquired Vienna International Airport. And in 2015, we acquired 2 toll roads, one Indiana Toll Road, and that minority stake in a Mexican city toll road called Conmex. So we were able to originate further investment within Conmex by buying another 25% stake in 2015, as well as buying the parent company in 2017, as well as the holding company in 2018, which gave us exposure from just one single toll road to a portfolio of transportation assets across 5 countries. So that's 19 assets within toll roads, airports, light rail, and seaports.
So,
And it's important when you hear this to also understand that there's toll roads and then there's toll roads. And they have very different characteristics. Our Indiana toll road is a freight road that goes from east-west. It's a critical piece of US infrastructure that is very long-term, a long traffic history, GDP linkage. Users pay tolls, that's how that goes, and that's what comes to us. When we took that exposure in Mexico, that was backed by a government guarantee on the revenues. So that provided a very different risk profile and return profile that didn't have the correlation with the Indiana toll road. This is how we looked at it, is how can we continue to add in areas where we've got strengths, but also do so in a diversified and risk-conscious way.
So a couple other takeaways. One, we've been able to deploy $20 billion since 2013, so over $3 billion a year in very competitive markets. And second, we have shown that we can sell assets as well, and that we're actively managing the portfolio exposures of some of these portfolio companies. So Indiana Toll Road, which was a large part of the portfolio in 2015, we then partially sold down 15% of that asset within 12 months. You can see these divestitures down at the bottom. As well as we started to acquire larger stakes in that Latin American transportation company, we then sold down a portion of that Mexican toll road, Conmex, to a large Canadian pension plan. So we're actively managing these exposures as well as taking advantage of some unsolicited bids in terms of the 50 Hertz transaction, which was that electric utility David had talked about earlier.
So I'm just conscious of time. There is a nice map of our assets. We also were going to talk a little bit about our asset management, responsible investment, and the terms. I'll take your guidance on how to use what is left of any remaining time, or questions, or anything that can be helpful to you all.
How long is your queue now? And if we made a commitment, how long would it take to deploy assets?
So we, again, like everything with IFM, you'll come to appreciate if you, we do things a little different. We have a queue. We guide investors towards a 12 to 18 month drawdown. That seems like a long time for some investors, but we only draw from the queue to fund new investments and large earmarked capital expenditures that were already budgeted. We do not use the queue for anything else. We don't use it for ordinary operations or anything else. And so our queue is dependent, the timing is always dependent on when there are opportunities to invest. And so what we do is we manage to build a queue that's in line with our pacing. Chris said it's about $3 billion a year. That is not $3 billion each year. It goes like this. But that's how we try to size the queue. So that's our queue policy. You're not charged on capital at that time, obviously, until you're actually drawn into an investment, and you are typically drawn all at once. So you get your full exposure to the full portfolio from day one. You don't just draw down pieces. Having said that, we just completed that very large transaction Chris mentioned. That was a $4.5 billion investment that wiped out our queue. So whilst we will always guide investors toward this 12 to 18 months, I can say historically it's been on the low end or lower than that low end in terms of timing. And we have a very robust pipeline of both new opportunities, some are in the news that IFM is competing on here in the US, public processes, as well as opportunities, as Chris said, through our portfolio. So I'm kind of hedging and dancing around it because we're not going to tell you it's going to be tomorrow, because it won't be tomorrow, but that 12 to 18 month guidance, historically, or over the past several years, it's been much shorter than that.
So your returns have been pretty different from JP Morgan's.
Mm-hmm.
And if you look at your country exposure, you have investments in Turkey and
Yep.
Peru and Chile, Colombia,
Yep.
Mexico. Are your returns higher because you're taking on more risk, or are you guys just that good?
So can we answer that? Well, just on the geography part, we do have some exposures that you mentioned in quite frankly, in countries that are newer for IFM. Right, we've done so in a way we can talk exhaustively about how we thought about it, why we did it, what's happening. These have been all very consistent with our investment case, very strong investments. They've also been sized in a way to manage. They are a long-term opportunity for us, and we do have as a $30 billion pool of capital the ability to take on exposures that are not going to move the needle for the fund. So our Turkey exposure right now is about 3% of the fund. So just to be clear in terms of thinking about, when you look at the geographies, these are not what is driving the returns. What has really been driving the returns, to be frank, is really a couple things. One is that we have had these exits, and these exits have been at significant premiums to where we hold the assets. So if anyone's questioning valuations, they can look and see where the fund marked it, because we do quarterly valuations, so it'll be the last quarter, and where we sold. And it's been significantly above and significantly above the valuation. So that's been the return, and that's gone back to investors. The other is we are constantly, and we are a busy team, and we're doing a lot of value creation initiatives that do expand our assets, make them more competitive, and have been per the valuers. The valuers have to take a view, and they increase the value of them. So I do think that we have a really great portfolio of assets. I do think they're doing what they're supposed to be doing. When you look at the returns, a couple of things should give you comfort. One is that this is from the market saying, you guys have good deals and we want to pay you a lot for it, which we will not keep, and just continue to, for example, charge a fee on. People ask us how big we're going to get. As Chris said, we will sell assets, and we have sold assets if it's the value to investors. And so a lot of that, what has been what we look at as outsized returns has been just an endorsement of that. But we like to think too that all the work we do on our assets is generating value that is getting, and they are assets unlike maybe a standalone wind farm, where we actually have levers to pull. That's the kind of assets we target that can increase in value, because we have investors who have been with the fund for a long time, who are today putting more money in, and they need to see the continued growth in that.
And your minimum investment's $10 million?
Yes, that is correct.
Okay. And what do you do with currency?
So we have a currency hedging program. We've been doing that for over 10 years internally. And we hedge all investments back to the US dollar. And it's included within the management fee for investors.
So if Mendocino would make a commitment, do they pick between two funds, or the one fund they can invest in is a US dollar hedged, where you go through and you hedge the exposure to all the portfolio companies that might be domiciled?
So it's one fund, and we would currency hedge every non-US dollar denomination back to US dollars.
It's pretty simple. There's one fund to come into, and it's hedged, and the net returns you see are on that hedge basis. So hopefully that's clear.
Just one other stat on the geography point. So the fund has about 75% split in total between US, Canada, and Western Europe. And about 45% of that is in US and Canada. So the majority of the fund is in OECD.
That's the market value of the assets, or the number of investments?
It's the market value. And it's a good point that we own platforms. And some of these platforms have underlying assets. So it's not the parent company, small underlying assets. They're global businesses. We own marine terminals, and as Chris said, this portfolio of 19 concessions in 5 countries. Some of those are smaller. That company is based in Spain, but there are underlying exposures. So that we do report that, so people see where the underlying assets are in the portfolio, but those are not necessarily on the and not across the board on the portfolio company level.
When you invest in something like the Indiana Toll Road, do you buy or create a company which then operates the toll road? Or what's the actual legal structure of that, as opposed to you saying, I own this road, as if you owned a piece of real estate?
Right. So with Indiana Toll, we own the concession to operate that road and to collect the revenue.
So does that mean a contract?
Yes.
Concession?
Concession, yeah. Concession with the Indiana Finance Authority, that it's a public road. But they have the right and the ability to partner with the private sector. They can operate it themselves, or they can partner with the private sector, do pieces of it. In this case, it's the full ability to operate and to collect the tolls on that road.
So that's a contract?
Yep.
I mean, so in your whole portfolio, how much of it is based on something, and how much is based on contract work or revenue type of programs?
Yeah, so that I would have to go and think about, but I just want to clarify, without that operating contract, there wouldn't be a value to, it would just be effectively land.
Right.
So it is zoned, regulated, and operated as a state road. So there's nothing else that, so without that, there's effectively not.
Well, for
The
you,
only economic value is in that concession. Contract.
well, actually,
Why does
yes.
the state need you in that situation?
It's a great question, and there are states that don't, and they do it themselves, like California. But they decided that it is, from a risk standpoint, there is this risk sharing to have another party responsible for the operations and maintenance of a road, as opposed to the public sector
So
doing
you
it.
fix the potholes too?
We
You
do
don't just take the
everything.
tickets. Okay.
Do you want to talk about Project Push?
But they own it.
So the reason why we were picked for this concession was because they knew that we could manage the road sustainably. So the reason why Indiana doesn't do it themselves is because they wanted the money up front from IFM to then put that money towards other projects in the state. So it's creating roads that don't have tolls on them, repaving them, building social housing, adding more flights to their local airports. But IFM was chosen because we could show that we had the expertise to manage the road. We have a toll road specialist as an executive director who ran and founded Transurban, which is a private toll road company based in North America. So we had a number of initiatives, and the Indiana Toll Road was actually underfunded, and it was there wasn't enough maintenance before we acquired it. So when we acquired it, we repaved the roads, $200 million CapEx project.
It's the largest project since the road was operating since
That's right. So we repaved the roads, which actually helped us with life cycle costs. So it was accretive to IFM and our investors.
and safety, obviously.
We improved safety, we added safety guidelines, we added more cameras to the road. We redeveloped the travel plazas, which are solar powered.
Which originally were built in the 50s.
We demolished the old travel plazas and rebuilt them, state-of-the-art facilities. And we've also installed wind turbines along the highway, which gather energy from the trucks driving by to reduce the cost of.
But just we could go into all these fun examples, but at the end of the day, and they are very good, and I think it tells a great story. But at the end of the day, for Indiana, it's the main economic. It's a huge economic corridor for the state, and they wanted to maximize the value that could be generated out of that, and they also wanted to minimize their own responsibility and cost for doing so. And so not every state will do it. If there isn't a revenue tied to it, like a toll, it's very difficult to bring in the private sector. But when they know that this is an asset that's not being maximized in terms of the value, and they have other assets that don't generate revenues and don't have a revenue stream, they can take that capital and recycle it into other projects that are important to communities, but the local roads and, as Chris said, schools. And so it is very common outside the U.S. It's not as common in the U.S., but the Indiana tour is a great case study of the value to the public sector and the value to investors, because it really was a win-win.
Was that run by the state itself before you guys got it?
So interestingly, it had been historically, and then it was privatized, and I want to say 2006, right in the peak of the market before the GFC, by another well-known infrastructure manager. And basically, it's a case study for different approaches to management. It was a shorter-term ownership strategy, the use of a lot of debt and very aggressively structured debt, which was not uncommon at that time. But basically what happened was the market shut down and they could not go back and refinance, and they started getting behind on the payments, because even though the traffic continued to hold up quite well, which is what you want to see in infrastructure, people continue to use that road. The problem is, if you're getting behind in your debt, you need a lot more than the day-to-day to be able to catch up, and they didn't. And so it went into bankruptcy, so IFM acquired it out of bankruptcy.
So the company that was managing it
Yep.
went into bankruptcy.
Yep.
It was over-leveraged.
Over-leveraged, right.
And so again, to the point about why we don't do that, is we've seen what happens and what can go wrong. And we don't need to get the 15% or a high return from this. This is not meant to do that. It's meant to be a predictable, stable, defensive core asset, and not a kind of private equity or leveraged strategy. That's how we looked at it, and it's been, from the Indiana perspective, it's really been a win-win.
Can you or either of you talk about the 33% catch-up and the 50% holdback for fees?
Yep.
And why that may be different than some of your competitors?
It's still, I think our fee structure is still very much on the low end when you look at it in its totality, compared to most managers, when you look at where our management fee is. And we have this here, so if people haven't seen it, it's on slide 24. So we have for investors under, I'll just frame it how we talk about it, and Chris chime in. We start with our management fee, which is 77 basis points per annum for investors under 300 million, and then there's a drop for investors above that. Again, we don't charge on undrawn capital. Our performance fee, 10% of that, of that 100% goes to IFM, and 90% goes to our investors. So when we see what is now an 8% return, so there have been shifts down and that hurdle above which that split starts happening. And what the catch-up does is it's effectively a timing mechanism that allows, after investors get their return, then 33% of that goes to IFM to catch up before it goes back to the split of the 10% and the 90%. So it is more of a, assuming that the asset continues to perform and there is a management fee to get, this all doesn't matter if you're not hitting the hurdle. Doesn't hit the hurdle, nobody gets anything. So it's above that hurdle, and it is that timing. What we do is we hold back 50% of any performance fee that is accrued each year. Hold it in escrow should the fund underperform. We have a good year, and then that performance fee is paid. We felt like it was important to be able to have some mechanism in place to pay investors back if the fund the next year were to underperform. So it is there really just for the benefit, we think, of providing more equity between
It's nice, like smoothing as well. To good years it's smooth a little bit, and bad years it's smooth as well.
Yes, it's a sharing there. It's there to let you know that we're not focused like everything. And it does get a bit, I know I probably get tired of hearing it. Everything is intended to promote us to do long-term thinking and not try to do anything in a year. Because if there's a good year, great. But if there's a bad year, that's not going to work for you, and it's not going to work for us. So that's why that's there. Just briefly, otherwise, you see there's no other fees, which you should always be looking at with your managers, so you see the fees there. And also, I do want to stress with evaluations, since this is what you're paying the fees on, it's really important to understand. We did make this decision many years ago to have every asset independently valued on a quarterly basis, because we do have investors coming in every quarter, and we want to make sure that they are not relying on IFM for the valuations, but you know, there was one of the big four, and they rotate, so we don't let anyone stay more than a few years on an asset to make sure that there's, and then when you look at where we have exited some of those assets, you see that we've been, I think it's fair to say that those values, as I said, were below where the market would have valued them.
Could you use an example of your performance fee if this year performs at 10% and next year performs at 6%?
Mm-hmm. So if the fund performs at 10%, which would be 2% over, there would be that 2% that would be generated, that would be split again, a 10% to IFM, 90% to its investors. Now, of that 50% of that 10% that IFM gets will be held back, will not be actually paid to the fund. So that in that next year, if the fund underperforms and does not make that 6%, that 50% will be contributed to catch up the investor to that hurdle. Now the numbers will all depend on what we're talking about in terms of what the quantum is and so forth and the valuation changes, but that's how to look at it, is there is that 50% that sits there that says that if we don't meet that, and it got paid out the year before, that we should try to make whole and contribute that 50% to make up that difference.
Okay, thank you.
And someone audits your fund
Yep.
to make sure all of that
Yes.
complicated stuff you just said is accurate.
Yes.
So who is that?
So we're actually audited twice a year, the fund. So the assets are independently valued on a quarterly basis. And then the fund is audited in December by the fund auditor Deloitte. And then the fiscal year end for Australia, which is June 30, we're actually audited again by the Australian Prudential Regulatory Authority. So it's basically 2 audits per year plus the independent valuers for each asset.
And the fund valuer is not, the fund auditor is not, does not value any of the assets.
Has it ever happened where you've given money back on that 50% holdback?
I knew you were going to ask me that, and I should have answered that. I'm not aware of it. But that I would need to, I could come back with, but I'm not aware of it. You see our fund performance, so our fund has been outperforming since inception. Now, on a year, and whether that occurred, that I don't recall.
Okay, I think we're a little over time. Are there any other questions for IFM?
So on the fund performance, you mentioned in the last couple of years you sold some decent assets that helped build that performance. And were they valuable enough to have a significant impact on these averages here?
For the returns?
Yeah.
Oh, yeah, absolutely.
Like 2%, 5%? 5% of this period, like 9%, was it 4.5% or?
They were significant. I mean, we sold 2 standalone businesses. Well, we owned a portion of 50 Hertz, and we owned a utility in Pennsylvania that we sold, and then we've had the partial sell downs, including close to 15% of Indiana Toll Road, which was over $3 billion of investment. So yeah,
So that was a 10% of your portfolio?
Yes.
Okay.
And so what you would have seen had we come earlier, a few months ago, you would have seen a higher short-term performance was higher. And now it's started, as the fund has grown and the size of that asset, those exits diminish because of the growth of the portfolio. They're now sort of normalizing, coming down.
Thank you.
Very good.
Thank you.
Thank you.
Thank you all very much. Really appreciate the questions and the questions.
Safe travels.
Thank you.
Very good.
interesting.
Tour these facilities.
Yeah, very.
On our own.
Australia?
I'm gonna go to Australia.
I'll go to Australia. I'll go with Jeff.
On our own nickel. But when we're there, it's great.
Short break.
Thanks a lot. Good to see you. Safe travels back home. Appreciate it. Yeah, appreciate it. Thanks for your time. Thank you. I think the idea was to have lunch during the closed session. All right. I'll talk in the late.
And that was.
It just takes a while. And we had a good,
The answer was.
thank you so much for coming. Thank you so much for everything.
Thank you.
Thank you.
Smelling the food.
Yeah.
Very good.
What's our food? So we can start.
Oh, it's
Get
Mexican.
Whatever your favorite lunch.
That's so funny, because my sister was trying to call me, she was in town today, and she was trying to call me for lunch, and I'm like, oh, sorry, I just got this, sorry, I'm in retirement. And she goes, you missed Alice Tetra. No, I didn't. I'm having it now.
You can call me Sherry. So hopefully that was a good couple hours. We went a little long.
Very
Hopefully that
interesting.
was a good way to kind of bring this investment to life. We've been talking about it for a while, and it's kind of been in the abstract. But now hopefully it feels a little more concrete. Okay, what is this investment? What does it mean to make a commitment, 6% to these? I don't know if it's useful for us to summarize, or if we should just kind of go for a reaction if there's support to making an investment, and then if so, what do you do with the two firms that we talked to today?
Greg, I would throw out, I think, the first question is, how does the board feel about infrastructure as a space?
Yeah.
Let's focus on that question, and then if the answer is yes, then we can talk about the two firms in the space.
Yeah.
So that, no point spending time arguing about IFM versus JP Morgan if the answer is no. So,
Right.
So I feel comfortable about the infrastructure of the space.
Me too. I do too.
Bullish.
Quincy, I'm sorry. Quincy had concerns about going into this space before, and you were the one, I believe, that brought up the idea of hearing from some managers in the space, so.
My main concern, I think, might have been overweighted by some of the risk assessments that might be somewhat exaggerated by Callan.
I'll just on that, I sit near the
Yeah.
actuaries, and they said if we didn't put more risk on it, everybody
Yeah.
would put 100%.
I'd rather you go that direction the other.
Yeah.
But in all
So I
honesty-
You mean the volatility
Yes,
risk
the
or the
volatility.
qualitative
Yeah.
risk?
Yeah, the
From their
volatility.
mouth,
Yeah.
that's
Assessment,
what they
yes.
told. Yeah.
But after hearing from more on the asset class as a whole and from the presenters,
Yeah.
I think it does move us in the direction that I believe most of the people on board want to go, is to, limit some of that volatility and that risk. So I think it serves that purpose in my mind.
Yes.
It sounds to me like in both presentations, what we're doing is buying private equity that does infrastructure.
I think that's really insightful.
And then hedges.
Yeah, it is private equity like, though not transactional, not short-term oriented, and it's really focused on something that should have some inflationary real asset infrastructure, long-term.
Essential was the
Yeah.
word that I thought of when he was talking. He said,
Yeah.
you can go to the Best Buy and invest in private equity, or you have a road and an airport.
Right.
Those aren't really interchangeable.
Yeah, but they are private companies, you're operating private companies.
And I would say the biggest difference between infrastructure, these funds with infrastructure and private equity, is the ability to exit without a significant time period and amount of pain involved.
And this is all moving out of international equity?
Well,
The
no,
6%?
not all.
Oh.
It's a little split. It's like
Okay.
1% fixed income, 3% international, 2% domestic.
Oh, okay, I was
Did
thinking
get
it
that
was all international.
That's right.
4-1-1 or something?
Yeah, 1% equity, domestic equity, 4% international,
Oh,
1%
okay.
fixed income.
So 4%, so
Yeah.
2/3 of that will be out of international, okay.
Yeah.
So one of the questions came up for me at the end of this, when they talked about the toll road was, I was under the impression that all these were based on assets that were assets, physical and or operate, not or, but and operation. Well, they are a contract operator, so their asset is this contract. Is there a difference in each of the companies and how much they do? Either way, the first one, like, talked about having 100% ownership, which means they ran them. Which
They ran the company.
Yeah, but they also own the thing.
Yeah.
Where this is a little bit different than where they're partners with people with expertise in a particular operations. Is that a characterization difference? Or
I think they're, I mean, JP Morgan, to be fair, also owns an airport where they also, I think, have a contract to operate that airport. IFM owns the Vienna airport in Manchester, so JP Morgan has a portion of that. But I think you're right, IFM tends to do bigger investments, and they may be in things that are operating airports or roads on behalf of governments with the Port of Singapore, who knows a thing or two about that, as their partner. So they do have different strategies. JP Morgan is investing in smaller assets, in part because they're a smaller fund, and they're investing more 100% ownership of those assets. That's kind of their thing. IFM may be partnering with well-known operators, so it's a good observation, yeah.
So I'm hearing that there's a consensus, board consensus, that we are interested in 6% private infrastructure.
That's great. So then we're left with two firms, IFM and JP Morgan. Their returns are different, and their strategies are different. And I asked that commitment question at 10 million for both, because you're going to be putting 30 million to work. You could, instead of picking two, you could say, I want to diversify and be in both. Not knowing who's going to be the winner next year, the year after that. There's a lot of variability between the two.
Different strategies.
Very different strategies. So there's, we could pick one or the other, or you could go with both.
I agree with what you said. I agreed with everything everybody said. I gotta tell you, I was a hard sell on infrastructure, but it's 6% of the portfolio, given its risk and its small segment within our overall portfolio. I don't see it as anything we need to lose any sleep over, and it could be very profitable. So, and I like the idea that both managers have a different strategy. They're both top flight at what they do, obviously. So that's the way I feel.
My personal main concern with IFM was based on those returns, that they were overly cognizant of the returns and over-focused on it. And after talking to them, I don't feel that way. I think they've just done well. And they still have the strategy that it's based on opportunity primarily, and then obviously with analysis of the risk involved.
And they're owned by pension plans.
That
It's-
got my attention
that was
from
crazy.
it.
Yeah.
Are we buying into that?
They got my attention from the beginning that there's
Yeah.
3 county retirement associations as investors, and
CalPERS already.
And
And
CalPERS.
they both
sounds
have
like it, yeah.
CalPERS, so
And-
we know that somebody
They're both
really stuck a
reputable.
microscope in their ear.
JP Morgan has new commitment from CalPERS. I'm not sure that IFM has CalPERS or Cal.
They have
As
CalPERS.
an investor,
Actually,
they have
they
fund.
said both. They said two though, they
Okay.
said two
But
major.
And I don't know that for certain. I
Yeah.
know it for JP Morgan, and I don't know if they've done co-investments with them or things like that. So I don't want to represent.
During,
I'm not
during
certain.
staff's call with IFM, they said that CalSTRS was a client.
Stirs, okay, good.
And our advisor has investigated them thoroughly, so if they come on your recommendation, you've done our work for us.
Yeah.
So we didn't ask the question, the second one's, is a subscription and we write the check when they're ready to spend it?
Yes.
So you make a commitment, and when they're ready to put the money to work, they will call the capital. And you have ample liquidity in all your investments set.
Right, and then the JP Morgan with the 4-year out, you commit, you don't have a 4-year out, do you give them the money?
Until you've given, until you've funded it, and then
Right.
once you
You're
fund it, that
following.
4-year clock starts, yes.
I might have been reading between the lines, but it was interesting to me that IFM had a longer range of being called upon for an investment of up to 16 or 18 months, but when they were here, they've exhausted that queue.
Right.
And I would be shocked if they didn't call on us
Quick,
earlier
yes.
than JP Morgan based on the
Definitely, yeah.
presentations.
IFM just completed, they didn't talk too much about it, but an acquisition of Buckeye MLP, a midstream pipeline in the US, massive. There's $5 billion and their fund size is 20, so it's significant, but it's, in a way, it's good, it's US exposure, right? And it's diversifying from transport, so.
Just want to throw something out there. If we split it up 15-15, is there any thought of doing 20-10? Is there any one that people like better than the other?
I thought that one, and it was 2010 for IFM.
That's exactly what I was thinking.
That's where I was going to.
That's exactly where I was going,
I felt
yes.
much better, but I mean, I felt good about both.
I felt,
but-
right.
But
But-
I saw no holes in IFM.
They're the whole package, and it felt like JP Morgan's there, but I felt like more like a 2010. That's kind of how I was, at first I was 15-15, thinking going into this, that it might be worth it just to do 15-15, but after the presentation, I'm kind of like 2010 IFM, yeah.
Well, I thought that IFM presented much better. It was a very good presentation, but that isn't, it's,
That's what they do.
It's the same.
We also
They
grilled
hire the
JP
best.
Morgan, like.
Well, I just like their whole pension, the fact that their pension
We grilled the
funds.
first one
Yeah.
too much.
So, Jan,
Mhm.
if you're making this decision for the Cowan
Retirement pool?
retirement pool,
Sure.
what would you do?
I like the idea of, because you get a diversified portfolio, you have 40-something assets working for you plus versus less than 20, so I like that idea. Whether or not to split it equally or more heavily weight one or the other, I think the JP Morgan fund is gonna give you more of a baseline return in the fund, right? So with the solar and things that you're just gonna get that. IFM, you're going a little bit more growth, so I like IFM as an organization. I could do equal weight, or I can do 22 IFM, make it more.
The 30,000 that we talked about, is that, are we on a trend that could be bigger or should be smaller? Depending on the allocations that's being taken from.
Hope it'll be bigger.
One idea, if I can jump in here, is you have the option to reinvest the dividends that are coming out of it. So if you have enough cash right now, you may consider just telling the managers, let it ride.
And that has been our policy. That's what we do with real estate currently, is just reinvest.
So once you're in for your 10, you can put in.
You could, but it may take a while for them to call it.
Yeah.
I would keep things simple. I would, I think IFM, I find their structure very compelling. All else equal, keep things as simple as possible. So for that, I would just say split it in half.
yeah.
And then let them compete against each other?
Yeah, and then they'll come and go over time.
Uh-huh.
4 years from now, we might wake up and say, why do you have twice as much money with this one than this one? There might be a different group of people around the table. And
No, they'll all be here.
5 years, right? We got a commitment.
So I move that we establish a 6% allocation for infrastructure.
I'd second.
investments.
So we want to do it in 2 steps then?
I think so.
Okay. Any discussion on the motion? All those in favor?
Aye.
Opposed? Abstained? Motion passes.
I move that we allocate $15 million to
Let's say, split the allocation evenly.
We split that allocation equally between the 2 presenters.
Because it might not be exactly 30 million.
You're right.
Today, it's more than that, so.
Good.
Is there a second?
I second.
Any discussion on the motion? All those in favor?
Aye.
Opposed?
You're quick down there. I was gonna say, I like the growth aspect that I have.
Well, the only, and
Yeah.
in a lot of ways too, I think that's probably really good advice, because then what'll happen is too, if we wanna put more in then maybe we do wanna go growth and we wanna go with IFM
Yeah.
down the road. But what it does is gives us both of these equal footing at the beginning, and then it gives us an opportunity to put in more, and where do we wanna put it? Because it's very possible over the next several years, we'll put more, maybe
Yeah.
we'll change our allocation.
Yeah.
So I'm good with that.
Let's hope it's a sleepy little corner of our portfolio, generating.
No
about 8 to
excitement,
10%.
no, we don't want any excitement.
You don't want it to light up.
Stable, yeah.
Okay, all those in favor? Opposed?
I think we already did.
No, we didn't,
This
we
is-
started to do it.
Yeah.
Oh,
Yeah.
Somebody second.
Opposed?
anybody opposed?
Yeah.
Actually, you did get the vote in before I come.
Abstain, no, okay, motion passes, we're gonna do.
Okay,
Great.
thank you guys.
Very good.
That was
Yeah.
very interesting.
Good work.
That was a lot, that's a lot for us. That
Yeah.
is a lot, so thank you guys. That was a lot. That
It's
was
like
a lot
going
of
to a
education.
museum, you can only look at the art for so long. You just gotta go to something else.
What do you say when you go to the Redwoods and you were on Reagan?
Did you guys stay for lunch?
Okay.
You know what, we've got to drive back and we've got a conference call in just a little bit, so.
Okay.
Yeah, so.
Thank
Good to see
you.
you all. Thanks a lot.
Thank you. Yeah, thank you so much.
Good.
A lot of work on your part.
Yeah, and I was glad you
Had a good
it
discussion.
kind of- it feels accomplished, because we have never, I mean, that's been a long, long time since we, when's the last time we ever did anything? Yeah, I mean, I think that was.
Happy holidays, guys.
Happy holidays.
Good job.
Yeah, no, I mean, that was a lot for us, because we're conservative. I mean, it feels like, we don't jump into things lightly, so.
It was a few days where we get to actually look at facts, ask questions, and make a decision.
Yeah.
Rather than our learned counsel tells us, well, this is the way it is.
You got this or that.
You gotta give
Yeah,
them the-
you gotta make a choice, yeah, we gotta make a choice.
You gotta race.
Yeah.
Okay, I have a suggestion. Would you like to do items 7, 8, and 9? It shouldn't take very long. And then-
I just have one question, is lunch here?
Yeah, lunch
I
is
think
here.
if lunch is here, we should eat it when it's hot. Is it fast though?
Yeah, it's fast.
The items are really fast?
We were gonna do,
Oh, then we'll go right into
lunch
it.
during
Okay. You guys
closed
know.
session. It's a closed session.
So we're gonna go with what Catherine and James want.
Okay, good. Discussion
Seven?
Yes, item number 7.
and possible action regarding solution 2019-04, defining compensation earnable pursuant to Government Code Section 31461 for members who are not subject to Government Code Section 75223, non-PEPRA members.
Thank you, Madam Chair. Trustees, you have the memo before you that lays out everything with the recommended motion. I'm happy to answer any questions.
Madam Chair, I move to adopt resolution 2019-04 as presented.
Wait a second.
I have a question.
In discussion, we can.
I'll second
discussion.
the motion.
Yeah,
Okay,
in discussion.
Just on page 5, B1, looks like, I don't know, maybe I'm misreading the sentence, it seems like an incomplete sentence. Maybe we need to look at the comparison in the PEPRA.
Page
It
5.
says, any compensation determined by the board to have been paid to enhance members' retirement benefit under that system, that compensation may include, and then it doesn't have a list. And
That is
I
a-
think that's.
That is a direct copy from the statute.
I
Wow.
think it's referring to the language above that. It shall not include any of the following, any compensation.
But that sentence ends with a.
Yeah,
Yeah, it's not-
that
It's not
definitely.
right in the
Okay.
statute.
It's not right in the statute.
Shocking.
Shocking.
But good catch.
Okay, other than that, go ahead and take a vote. Okay, all those in favor?
Aye.
Opposed? Abstain? Motion passes. Okay, next is discussion and possible action regarding Resolution 2019-05, defining pensionable compensation pursuant to Government Code 75223.34 for members who are not subject to Government Code Section 31461 PEPRA members.
Thank you, Madam Chair. Trustees, you have the memo explaining the new resolution, and there's a recommended motion. I'm happy to answer any questions.
I did the last one, somebody else has to do this one. Tom?
Well, Madam Chair, I move to adopt resolution 2019-05 as presented.
Second,
Second.
the discussion on the motion, all those in favor?
Aye.
Opposed, abstained, motion passes. And number 9, discussion regarding administrative report.
Thank you, Madam Chair. Trustees, you have the administrative report. I'm happy to answer any questions you may have.
It's a very short report.
Yeah.
So we don't need a motion.
That concludes, no action needed.
Okay.
Okay.
So next, we're going to go into general board member discussion. Any general board member?
I have a keyboard in my car for an Apple iPad, for an iPad. Kind of opens up and there's a keyboard. If anybody wants it, they can have it.
That's nice.
Okay. Any other discussion?
Anybody else have any giveaways?
Good to see you, total assets now.
Well, I've got you all
$540 million mark, so.
Okay.
I think we've since hit 550.
Yeah.
We don't have the end of November report from Callan yet, but assets have hit 550 at the end
That's
of
very
November.
nice.
Mhm.
All right. So we're going to lunch and closed session.
All righty.
Great for.
Very good.